The 2020s didn't start the way any of us expected. Things that seemed so secure at the start of the year seems a lot less sure right now. But every challenge has a seed of opportunity inside it. And this crisis is no different. Now is the time to adjust. I've been through crisis before, several of them. I know that first you survive and then you thrive. I'm Simon Dixon, and for 20 years I've been helping everyday people navigate the financial markets. Since 2011, I've helped many invest into the highest performing asset in history, Bitcoin. This time last year, I gave a free 4-part video series on how to build and protect your wealth in the Great Depression of the 2020s. The portfolio since then has outperformed financial markets by orders of magnitude. So now, over the next week, I want to update you on everything that has changed and show you why now is the best time to adjust in the most interesting and exciting time to be alive in financial history. Welcome to the brand new Retirement Plan B live masterclass. Hello, everybody. Welcome back. We are at Masterclass 2. And I think we've got the hang of things here, but I don't want to jinx it. But everything's plugged together and seems to be working okay. So if you are on YouTube or Twitter or Facebook or wherever you're streaming in from, can you leave a little comment below and let us know that you can hear me okay and the sound's coming through and everything is good, because we have got a lot that we want to cover. So if you didn't watch Masterclass 1, don't worry, play full out. We'll be just doing Masterclass 2 right now, and the live recording is available for you on retirementplanb.com, where you can go back and you can review Masterclass 1 in your own time. We had a roller coaster ride. The feedback was absolutely tremendous. We had hundreds and hundreds of comments, and we're going to get through some more comments, but I've also got a lot of content to cover today. So today in Masterclass 2, the main focus was around cryptocurrency tax, but actually that's only one part of it. I've got a lot more in store for you. The first thing we're going to be doing is we're going to be reviewing the 7 lessons and mistakes that I covered in the 4 3-part video series last year, and reviewing what happened if you listened to those and reviewing the lessons and mistakes. We're then going to be moving into asset protection. We're going to be moving into asset allocations of my retirement plan B. And we're going to be looking at how to deal with cryptocurrency tax. Not a tax advisor, but I'll be sharing with you how I deal with it. And then we're also going to be looking at the power of compounding, which are really some of the 4 bedrocks and pillars that make up the retirement plan B approach. So let's jump over to the slides. If you weren't on Masterclass 1, the main focus was figuring out, should I buy or should I sell Bitcoin? And we went through the approach that I follow, which is just cutting out all of the noise. And we also went for a review of 5,000 years of monetary history. And we went through all of the return on investment that was achieved and everything that changed in the economy with the money supply, inflation, interest rates, and hopefully I covered it all in plain, simple English with minimal financial jargon so that everybody can follow along and get something from this. Because that really is my purpose in doing this masterclass. I want everybody to be unshakable, whether we get hyperinflation, inflation, deflation, hyperdeflation, economic growth, economic decline, because retirement plan B is designed to be prepared for all outcomes and all seasons. So Should I buy or sell Bitcoin was the subject of Masterclass 1. The main hook for Masterclass 2 is how do I deal with cryptocurrency taxes? We'll be covering that towards the end of the Masterclass. We're going to be going live from approximately maximum of 3 hours. Last time we did 3.5 hours because we were all having such a good time and time just flew by. It really only felt like half an hour to 1 hour. So how do I cover the cryptocurrency taxes? But before that, we'll be reviewing video 2 of the 4-part video series last year, where we covered the 7 mistakes, lessons and mistakes. When we're going to go live next week on Monday, same time on Monday, we're going to be going through cryptocurrency structuring and retirement planning. And then finally on 4, we'll be going through and reviewing how to build and protect your wealth. As a quick recap, if you're watching this for the first time, we had so many people sharing. Welcome to this. In a minute, I'll do a quick recap of who I am and what we're trying to do here. But to give you the brief overview, last year I created a 4-part free video series, and I publicly invested $1 million of my personal savings, and also shared with you exactly how I would do it if I didn't have any savings and just a regular income. And so if you haven't watched that 3-part video series, don't worry. We're going to be reviewing that and updating it here on the live masterclass. Yesterday, we reviewed video 1 that we did. And now we're going to be reviewing video 2 and giving you all the updates. And I hold a personal belief that you could intellectually understand something. And some of you might be watching this saying, I know that, I know that, I know that. But if you're not doing it, then you haven't learned it. I believe that you start by learning something, and then by doing it is where the real learning begins. So I'm going to give you all the distinctions, the psychologies, and the strategy. But then it's when you put it into action that you're going to start learning. So if you haven't put into action and you didn't implement the retirement plan B strategy last year when we gave the free 4-part video series, then do me a favor, give me a commitment, turn off your Twitter, turn off all distractions, turn off those notifications, and just play full out, because I'm going to give you the best of what I've got from the last 20 years of obsessing in finance, mastering in economics, working as a market maker, working as an investment banker, attending the first Bitcoin conference in the world, investing in over 100 companies in the cryptocurrency sector, from Coinbase to Kraken to Bitstamp to Bitfinex to Circle to Ripple Labs and everything in between, and writing the very first book in the world that covered Bitcoin, which was Bank to the Future, Protect Your Future Before Governments Go Bust. Plus, founding the company that has 150,000 investors that had all been investing in the future of finance, and seeing over the last decade those that achieved tremendous results and those that didn't achieve such great results, and really giving you those distinctions. And that's what my goal is today, is to go through as much. We're going to have questions, so let's go through a bit of the housekeeping. The free 4-part video series, the first one that we reviewed in Masterclass 1 was my forecast on the Great Depression of the 2020s, where we had inflation, deflation, economic growth, and economic decline all in the Great Depression of the 2020s. It was a Great Depression like we have never seen before, and we reviewed exactly the allocations and how that did. This one, we're going to be focusing on how rich investors are investing, and I'm going to be picking out 7 investors that we covered in the video series last year and reviewing the lessons from there. In Masterclass 3, when we go live on Monday, we'll be doing the 5 Bitcoin investing and crypto investing and traditional market investing strategies that make up the retirement plan B formula. And then finally, on Tuesday, the next day, I can't remember, is it Tuesday? I think, yes, Tuesday. So much going on. We've really the team. We've got Azad here who's going to be doing the moderating, and we've got Dave over there on the decks that's making sure that transitions and everything work. Hopefully, between the 3 of us, we won't have too many technical glitches. But if we do, we'll sort them out. We'll come back online just like we did last time. And that is the final one: is building and protecting your wealth. And last year, we invited 500 people to join the online wealth management program, which is where, and we will be taking on 500 more people to join us. And so really, this live masterclass is designed for those of you that are not in a position to join those 500 spots. because we can only service so many people. And last time we had to close early because we got to that 500 very early. Because we can only service 500 people to a reasonable standard, then the live masterclass is designed for those that won't make that when we go live with the 500 slots. So that will be available after video for next week, and there will be a period, and then we're going to be starting class with the online wealth management program approximately 1 week after that. So we'll give all those details when we go through the 4th masterclass as well. Now, if you want to get your questions answered, then you're going to have to join us at www.retirementplanb.com. When you head over to retirementplanb.com, we ask you just to put your email in, and then we can give you all the notifications. We're going to be doing bonus sessions just for those on the email list. We're going to be doing all sorts of stuff until we get through to starting with the 500 people on the online wealth management program. So make sure you register there. The big blob, we can't do anything about it. I would be a silhouette if we didn't have it. We've tried everything. Next time we'll figure that out maybe. But that's going to be there. But don't worry, I'll make sure there's minimum stuff on the slide so it's not too distracting. But head over to retirementplanb.com, and that's where you can get your questions answered. I'm not going to be on the live chat on YouTube, not going to be in any of those places. Azad will be there. But if you want to get your question answered, he's going to be guiding you over to retirementplanb.com, because we've got a brilliant integration where no account is needed. You just ask your questions, and you can upvote other people's questions. And so the most popular questions will make its way to the top, and those will be the ones that we cover. So there's a bit of a democratic process to making sure that we're covering that. There you can see what it looks like underneath the video. And I think Azad's doing a screen share, so you're watching on there. You've got links to Masterclass 1, which you can return to afterwards. There on the board, you can just simply enter your questions, or you can upvote other questions that you like. And I think we had about 250 questions that we weren't able to get to. So those upvotes really count. So make sure you're looking for the best questions and as we go through this. And as we progress further and further, we'll take more and more time out to answer as many questions as we can. So we may be returning to these boards. So don't feel like it's time wasted there. Okay, what else have we got? So we'll be getting your questions answered. So make sure the best experience is if you go to retirementplanb.com and watch from there, where the video is embedded. Just enter your name and email there, and we'll make sure that you get all the email notifications and also all of the bonuses that we'll be doing just for those that are on the email list. So make sure you're on there. You're not using some fake email and whitelist that email, so you don't want to miss a thing on that. And also, we'll be doing a bonus just for those that are on the live stream. I know that sometimes you just can't make it. I appreciate that. This is a lot to commit to. But here's my commitment to you. I do not take your time lightly. If you commit to me, I'll give you everything I've got. And I draw my energy from the questions and the engagement that we get. So please do engage as much as you can. Azad will be in the live chat on the YouTube side, but the questions we'll be picking up are at retirementplanb.com. And as a reward for you for joining the live masterclass on the live stream, we're going to be playing a little sneak peek session. So, and that sneak peek session is from Pamela Morgan, who is my go-to expert when it comes to crypto retirement, crypto inheritance planning. So she's a qualified lawyer, been involved in Bitcoin. Andreas Antonopoulos is business partner, and she was one of the guest experts that helped the 500 people, all with all the templates and everything they need to do to put together their crypto-specific inheritance plan and inheritance structure, as well as Andreas Antonopoulos, who put together the security structures so that you can then build an inheritance plan on top of that. We thought through everything and logically put this through. And because next week we're going to be covering structuring, we thought that we'd get Pamela Morgan in as the guest expert. And it's just a sneak peek of some of the video content that we got from the Retirement Plan B online wealth management program for those of you that want a sneak peek and to see what types of things and how we've done it and how we put this together. A little bit more housekeeping. I am actually a financial advisor, but I'm no longer a registered financial advisor. I've done my qualifications, So I cannot give you financial advice. And as a financial advisor, when I used to be it, when I used to do that, I know you've got to sit down with somebody, you've got to know everything about their personal situation, their assets, their liabilities, their goals, their financial goals, and all the different things that one would need to do to give sound financial advice. This is designed to give you education and information so that you can walk away with your own financial advice. I want you to be empowered. I want you to be unshakable. And I want you to have the tools so that you can go and be your own financial advisor, and then also have the money to go find your own expert financial advisors. I pay a lot of money to advisors in order to make sure that the parts that I'm not so good at and I'm not an expert at, I have the correct advisors there. So I will be sharing with you, I have spent a lot of money on financial advice so that you can benefit in this live masterclass from that. I'm also not going to be giving you individual investment advice. I'm not going to say, you should be buying this coin, you should be paying this price. Here's the technical indicators, here's when to buy, here's when to sell. We covered a lot on how I think about buying and selling, and having been involved in Bitcoin for over a decade now. So that was all covered in if you want to return to watch a recording of live Masterclass 1, that's going to be up for the next few weeks until we actually kick off the online wealth management program as well. So I'm not your investment advisor, but what I do want to do is I want to empower you with exactly what I'm investing in and how you can take that and decide what's right for you. The third thing is that although we'll be discussing the steps that we take in sorting out people's cryptocurrency tax situations and giving them the tools so that they can go out there with their tax advisors and get on the right side of these trends. I'm not a tax advisor, never done my tax qualifications, and I'm not qualified to give that tax advice, but I will be sharing the structures that I paid a lot of money to tax advisors to support and set up, and some of the insights, having been involved in things like way back in 2014. I was a founding director of the UK Digital Currency Association. Shout out to all the old school Bitcoin OGs that were a part of that. And I do remember going into Her Majesty's Revenue and Customs with a bunch of crazy Bitcoiners and trying to explain cryptocurrency mining and Bitcoin and all sorts of stuff when they were trying to get consultation on the tax side. So I have consulted, Her Majesty's Revenue and Custom on cryptocurrency tax, but I'm not a tax advisor, and none of this should be treated as tax advice. In fact, you should always use your own tax advisor that understands the uniqueness of your country, your situation, if you're relocating, where you're going to, and some of the nuances with crypto as well. But I can give you the information so that you can at least level the playing field when speaking with your tax advisors. And I am not a lawyer. I'm certainly never done a law qualification in my life. I just happen to have been around investing in over 100 companies in the industry, knowing all of the different regulatory legal challenges and seeing the regulatory and legal environment, and having been involved in co-founding the longest standing company in Bitcoin, BnkToTheFuture.com, and the world's first crypto securities business. You end up having a lot of lawyers, a lot of legal counsel, and you pick up a few tricks along the way. But you cannot treat this as legal advice, even though we'll be covering things like structuring and the way that I'll be doing that in Masterclass 3. So that's the housekeeping. So now let's drive right into the content. And this was the second video that we covered on what wealthy investors are doing and the 7 lessons and mistakes. The way we're going to do this is I'm going to head over to the screen share. The video is going to play, and then I'm going to come back in and I'm going to review some of the lessons that you would have learned from last year, and then we can review what's changed and whether you're actually implementing it, and also sharing some new distinctions before we move into questions. So let's jump over to the first video on lesson and mistake number 1, which is on good debt overexposure. So I'm going to go over to the screen share, and then we'll come right back after that segment.
Welcome back. In video 2 of this 4-part video series, I'm going to share with you the biggest lessons and mistakes that I've learned from 7 of the most successful investors and high-profile figures in the investing and Bitcoin world. We'll cover Warren Buffett, Peter Schiff, Ray Dalio, Paul Tudor Jones, Robert Kiyosaki, Tone Vays, and Roger Ver. You'll have to wait for video 3 till we reveal the retirement plan B strategy that is built upon the lessons and mistakes revealed in this video. So it's very important to cover these first. If you have not watched video 1 yet, click the link on this page as we covered 5,000 years of monetary history as quickly as I could to save you the last 20 years I've spent figuring this stuff out. We covered why dollar-denominated assets, gold and Bitcoin are all important in the upcoming monetary renegotiation that I forecast is coming in order to recover from the Great Depression of 2020. You see, Retirement Plan B has been built using everything I've learned from 20 years in banking, economics, investing, and Bitcoin. In that time, I got to meet and learn from the best investors in the world, as well as most of the people that built the Bitcoin and crypto industry from the beginning. As co-founder and CEO of the longest standing business in Bitcoin, and having built the largest community of almost 100,000 qualifying investors that have so far invested over $850 million in the equity of the largest companies in the Bitcoin and crypto industry, I get a very unique perspective and insider's view on the investors that have become incredibly wealthy, as well as those that lost it all. Personally, I took huge risks on Bitcoin in 2011 at a time when the entire community could fit into one small room and everybody thought we were crazy. At the same time, I have a very conservative side to me, being educated in economics, working in investment banking, and being able to spend time one-to-one with some of the greatest investors in the world. By combining these two perspectives, I've seen firsthand the lessons and mistakes of thousands of investors from the inside, as well as the handful of investors that we cover in this video. I've used this obsessive study and experience to develop an understanding of what makes different types of investors lose money and make money, and I've used these experiences to personally achieve all I want financially using the same retirement plan B I'll be sharing with you in video 3. As crazy as this sounds, I found myself in a position to point out to the world what I consider to be the biggest lessons and mistakes made by 7 of the most successful investors and high-profile figures in the investing and Bitcoin industry, so you can learn from them and not make the same mistakes. So let's jump right in. Mistake number 1, good debt overexposure. When I was working in investment banking, I read a book called Rich Dad, Poor Dad by Robert T. Kiyosaki. It's an amazing book that inspired me to leave investment banking and focus on building a business and investing. Leaving banking inspired my wife and I to launch Bank to the Future and write my book, Bank to the Future, Protect Your Future Before Governments Go Bust. In his book, Rich Dad, Poor Dad, Robert Kiyosaki taught millions of people around the world financial literacy and the difference between good debt and bad debt. Kiyosaki taught how the rich use good debt to acquire assets that generate more income than the interest they need to pay to service those debts, and real estate was the main investment vehicle that met his criteria. I personally took his advice to develop a personal balance sheet and cash flow statement back in the day and used it to eliminate all of my bad debt. I also took his advice to build a business and focus on accumulating assets, but I never went all in on good debt and real estate leverage. Respectfully, I believe Kiyosaki's biggest mistake was going all in on good debt. Good debt does not prepare you for a period of asset price deflation or depression with huge rental non-payments like we would be experiencing right now if it were not for government bailouts of individual renters. I know he's now adjusted his debt leverage and he's advising everybody to move to hard assets like gold, silver, and Bitcoin. So I'm sure he's still doing very well. But for all the great lessons I learned from Kiyosaki, I'm also learning from what I consider to be his biggest mistake: good debt overexposure. Going all in good debt could have disastrous consequences for your retirement, and relying on real estate alone is too risky if you retire when unemployment and bankruptcies lead to huge rental defaults and you are burdened with all the debt but a negative equity real estate asset worth less than you owe. So what's lesson number 1? Mistake number 1 is good debt overexposure. And therefore, lesson number 1 is spend less than you earn, invest the difference, and become a lender rather than a borrower. Most people take on debt to consume goods, so never get to invest. If that's you, plan how to reverse that today. One of the first things we will do with our Retirement Plan B clients is get them to treat themselves as if they were a business and complete our quick and easy spreadsheets to give them a personal balance sheet and cash flow statement with a plan to be on the right side of debt tax efficiently. We'll cover more on debt strategies in video 3.
Okay, so we're going to pause it there. That was lesson number 1, which was good debt overexposure. From, as I said, somebody that was very influential in my life because of the book that he wrote, Rich Dad, Poor Dad. So what I want to do is share with you what happened over the last year and some more distinctions. If you remember in Masterclass 1, for those of you that joined us, I talked about this concept of Bitcoin thinking versus fiat thinking. And so fiat thinking, for those of you not familiar with the financial jargon, is traditional currencies that are forced upon us because the government says we have to use them to pay taxes and are legal tender. Fiat currency are based upon trust and they have value based upon trust, but that trust is being breached at a very, very fast rate because of the complexity of the financial system. The vast majority of people just have no idea. They just suddenly come along and are wondering, why is everything so expensive? Why is it so hard for me to make ends meet? And it's a slow hidden tax. The reason for that is because fiat currencies are money that you don't own. They're created by a bank as debt. And when you put them in a bank, they are digital currencies where you can't own them. The bank owns them. You can spend them if the bank gives you permission to spend them and they like how you're spending. And the government and the banks constantly increase their supply through the magic of how those digital currencies are created. And so because of this, because the supply always increases, the value of fiat currencies always goes down over time, and almost every single one of them has been destroyed and they never last. And so we're going through the end of a debt cycle where we talked about the dollar standard and various other things. But fiat thinking is the concept of being rewarded for taking on debt. The economy requires you to take on debt in order for there to be an economy. The money supply is completely backed by you as an individual taking on debt, by companies taking on debt, by governments taking on debt, by central banks taking on debt. And you have to increase that on what I call the world's largest regulated Ponzi scheme. So this drives everyone into debt. And that is fiat thinking. This means that when you have fiat currency, because you know it's going to be worth less in the future, the sensible strategy is to lever up in debt so that you have to pay less back in the future because the currency is worth less in the future. And also to spend it as fast as it can, which governments love because it increases in economics what we call the velocity of money. The speed at which a bank creates it and then it is spent around different people's banks account and circulates into increasing more and more levels of debt. And I don't want to get too geeky, but in economics, we call it a multiplier effect. And that's the magic in which banks are able to create more and more debt every time they issue a loan. Now that drives people into having to spend as fast as possible. And so you only have real 2 choices. The choice number 1 is to use that debt to consume, which is what a lot of people on the wrong side of the debt cycle do. And so if you used it to consume, then you end up with indebtedness based with no assets. And that means that the government pumps lots and lots, and the central banks pumped lots and lots of money in to the economy to stimulate real estate and property markets. And so those that own assets and they use that debt in order to buy assets end up on the right side of the largest wealth inequality gap we've ever seen. And that is fiat thinking. Bitcoin thinking does the opposite. Bitcoin is money you can own, money you can spend, and a fixed money supply. And so because the money supply is fixed, you have this scarcity where more and more of it goes as more and more people lose it. And you have the rewarding the saver. And so digital hard sound money allows you to generate a wealth effect. And when you generate a wealth effect, you're reluctant to spend that currency. But once you reach a certain level of wealth, you then want to take some of that out and reallocate it. And it tends to drive people to wanting to invest. So Bitcoin thinking is savings and investing driven. and a wealth effect. And fiat thinking is debt and consumption driven. And so the lesson from number one is that the fiat thinking world is all about you levering up. So because you know if you're playing the game correctly, you lever up in order to accumulate assets. Those that are levered up to accumulate assets get on the right side of this. Those that lever up to consume end up on the wrong side of this. And then central banks said, we're just going to double the money supply, buy mortgage-backed securities so that your real estate can't go down in value. And so that's where they're generating up, and that's the fiat thinking model. The Bitcoin thinking model is simply you being able to generate wealth, generate a wealth effect, and then use that wealth in order to collateralize, so you can borrow dollars against your Bitcoin without having to sell it. And so that's where you end up with a wealth generation and a collateralization effect. The exact opposite of the debt-based world versus the what I call equity-based world, Bitcoin thinking. And that is Austrian economics versus Keynesian economics, if you like, if you want to get a bit geekier. And so this is what lesson number one is about. But what happened during the last financial crisis? Well, it was all that overexposure from all the people playing the game of leveraging, accumulating, and then passing all those assets onto your pension, your retirement plan. And then the governments come along and bail out the banks because the disastrous effect, because all of those products were sold to your pension, and therefore that you end up paying it through a hidden tax called inflation, which reboots this cycle and this cycle. And now governments have come along and said, screw it. We no longer believe in free market economies. We don't let markets correct themselves. We will do whatever it takes to let markets continue to rise, because a correction is not something in our economic remit anymore. And so that's the whole concept of, and I'll be constantly referring back to that with fiat thinking versus Bitcoin thinking as we go through that. So that's lever and accumulate versus generate wealth and collateralize. That's a really different model. And respectfully, as we said, we talked about Robert Kiyosaki. Something really interesting happened over the last year. And as with most people that generate wealth, he started to realize the soundness of digital hard sound money and Bitcoin, and started to accumulate not only gold, but digital hard sound money, which is Bitcoin. And so welcome to the Bitcoin community, Robert Kiyosaki. He has been a very educated learner. What I really respect about Robert Kiyosaki is at his age, he is still open to learning and learning and learning and adjusting as new things go through. And so what was a real honor for me, because that book, Rich Dad Poor Dad, that he wrote, led to me leaving my career in investment banking, which led to a series of decisions that brought me to Bitcoin. And so it was a real honor to be able to work with Robert Kiyosaki, and he agreed to give some content just for the Retirement Plan B Wealth Management Program, and became one of the expert mentors on the psychology of wealth side. So we were really delighted to, and it was a real honor for me to work with one of my mentors that really supported me in my journey. And so just for that, we're going to move over to a quick message from Robert Kiyosaki on why he was involved, a quick message, and then we'll move over to lesson number 2. So over to Robert. Oh, I got it wrong. We are going to be moving over to a message from Robert, but first I believe we're doing the case study. Is that right, Dave? Let's just do the video first. I've got the pecking order. I thought it was lining up. Robert, we'll do Robert after this one. But I want to give and share a story. For the last masterclass, we wanted to have many of the Retirement Plan B Wealth Management Program graduates share their stories, because it's all very well me telling you what I've done over the last year. But what is really powerful is sharing the stories of some of the 500 people that joined us, and most importantly, took what they learned, put it into action, and quite frankly, Michelle changed her life was the word that she used. So I'd just like to share with you so that you can understand that this doesn't just work for me. This works for anybody that wants to put this in action. And in 1 year, here's some of the results that Michelle achieved. So let's play the case study, and video from Michelle.
My name is Michelle, and I am a financial copywriter. Yes, so before I started the course, I was in crypto for about a year. I was trading. I didn't know what I was doing. I was trying to do all this stuff these YouTubers were doing. And I was obviously not accumulating. I would sell and make money and do whatever. And it was all about fiat, right? And March 2020, I'd been watching Simon for a while, but I really honed in, and I decided to take this course because there was a lot of fear around regulation, fear around what I was doing, fear around taxation, just a lot of, fear. And I took the course because I was like, I need to understand the principles of cryptocurrency, and then also how the whole banking system, how the monetary system works, really understand. And throughout the course, it didn't take me long. I stopped trading instantly. I got myself an awesome crypto tax accountant. I got help, I found advisors who could say, this is what help me out. So I wasn't all over the place. And I started dollar cost averaging in, and it didn't take me long to almost have, right now I'm almost at a Bitcoin. So really for me, the course, I have a lot more crypto as well. So my portfolio went from 14,000 to it's over 100,000 at this point. And I started with a lot of debt too. I'm going to say that. So before the course too, I had a ton of debt. And the one thing, Simon sharing his story and just really interacting with the community, I'm now, I think it's 73% out of debt. And I have very little to go, and I've accumulated Bitcoin. My portfolio is over 100,000. I was able to, I feel a lot calmer, and I feel a lot more in control of the financial decisions that I'm making. All right, so it goes back to the very beginning of the course where Simon says, hey, fill this out, right? And it's an income, it's a balance sheet, right? And it's what's your income, what do you have in assets, etc. And when I looked at that and I got real clear on what I was spending, when I got real clear on the money that I could be investing that I wasn't, I didn't know where it was going, right? It's going somewhere, but it wasn't going into investing in my future. And just seeing that number and the spreadsheets and being able to play with them and say, if I put this much into my retirement plan B, this is what I could accumulate. And I started playing with it. And what it did is I've always been fairly responsible with not really, you know what I mean? I don't just run out and buy everything in a grocery store. I make the list, I do all the things, but I really got present to how I wasn't putting my financial future above all this other stuff. I got clear that I was wasting a ton of money on things I didn't need to be, paying for services I didn't need, doing all the things, and I found ways to cut back. And when I saw the asset versus, oh gosh, what's coming in and what's going out, right? I was like, I had a negative net worth, and guess what? I don't need more. And it took 8 months, and something shifted in me, and I was like, take this seriously. And this isn't, I think what I thought is, oh, if I just put all this money into Bitcoin and I do this, I'm going to get rich quick. And I'm like, no, man, this is a plan. It's a strategic plan. And that's really in retirement plan B. It was, here's the plan. We've got a plan, follow the plan, just follow the plan. And all that energy it disappeared. And I just worked the dang plan. And 8 months later, I now have an actual net worth. And, paying off that debt was part of it. I thought this course was not going to be anything about that, but hearing Simon's story and about how he had all this debt, I was like, if he can do this, I can do this. So I made debt just as much as a priority as investing. And I might have way more Bitcoin right now, but I figured, you know what, this debt is going to kill me if weighs heavily. And so that was my big aha, was that spreadsheet. Changed my world. So I can't pinpoint one, but there's two of them. Number one is that I went from a $14,000 portfolio. It's right about hovering around 140 right now, which is huge. And it's not even been a year since the course started, right? And I get Bitcoin is doing its thing or crypto is doing its thing right now in this bull market, but still. And I did it very quickly through dollar cost averaging. And the second thing is I applied the same principles investing in retirement plan B and paid off that debt at the same time. And being able to watch this go up and that go down has been phenomenal. It's changed my life. Oh my gosh, my financial future. I'm excited. I'm no longer, yes, I'm aware of regulations. I'm aware of what, but I'm not afraid of it anymore. And I feel that the foundation I have now, where I have actually a net worth that's positive, right? And I have assets and they're growing, and I continue to dollar cost average in, and I'm working the plan. It's freeing. Like I don't think since the course started in January, and probably as early as mid-March, I stopped freaking out. I stopped worrying about money. I didn't have to, because I had a plan and I worked the dang plan.
The infamous Simon Dixon, he's the leading proponent and expert and the first guy to ever speak about Bitcoin. I should have read his book. He is the Bitcoin way ahead of his time guy.
Oh, it's Robert Kiyosaki, and I want to thank Simon Dixon for inviting me to do this launch of this investor group. And Simon, I love your book, Bank to the Future and all this, but you're one of the few guys I will do this for. So anyway, I'm going to explain to you why I speak, why I think Simon is a great guy, and why his message is important. It's extremely important. What Simon is asking me to teach today is crucial for all you Bitcoiners out there.
Okay, awesome. As much as I love you, Robert, to hear that story, and it's just an honor, I really love hearing Michelle's story, because I can really relate to that. If you don't know my background, when I was trying to create a bank after leaving investment banking, I got myself £100,000 in the hole. I was, the red letters were coming through the post like crazy. I was ignoring it. I was putting it off. And one day I just sat down and said, right, you've got to get a hold of this, Simon. I was spending all my money on trying to make a business work. The business wasn't really going the way that I wanted it to do. I wanted to create a sustainable bank. I was told that I needed £60 million pounds at the time in order to have just the reserves to put in the Bank of England. And I had to go find the CEO and I had to build it on top of the traditional financial system. And it wasn't going to follow any of the ethics and values that we actually set out when we tried to start that. So I know firsthand, and I remember I sat down, with my wife, we sat down, we did our balance sheet, we did our cash flow statement. And it's really, really a liberating experience. Many of you may know the theory, but until you do it, you don't realize how much easier it is. And one of the things we do is we start plotting out some of the financial, the actual models of what the prices could do from there. And you start to realize, I don't need to mess around with any of these crazy things that I've been gambling around with, because I can see exactly what my financial future looks like. And I can see exactly how I can plan that out. Should Bitcoin, do what it has been doing for the last 12 years. And so that was just really an honor to do that. So thank you very much, Michelle. You're a superstar. You're awesome. And I love the community and sharing their stories. Look forward to sharing more of those. And I hope that inspires some other people to understand what is possible as well. Right, so now let's get back to the teachings. Let's get to lesson number 2. And lesson number 2, just before we go into that one, it was about stock market overexposure. So this one is for those of you that may have come from the traditional world. Maybe you've got a pension, you've got a retirement plan. And I'm not saying, stop doing what you're doing. That would be completely irresponsible. Carry on doing everything that you're doing. But my message is that everybody needs a retirement plan B on the side as well. And so let's look at the second lesson that is related to stock market overexposure.
Mistake number 2, stock market overexposure. When I was studying economics, I wanted to learn how the best investors in the world think. So I read every book I could find on investing, including The Intelligent Investor by Benjamin Graham, whose student was none other than Warren Buffett. Graham was the inventor of value investing, which teaches the art of buying undervalued stocks with little debt and strong cash flows. Traditional portfolio theory teaches fund managers to manage a balanced portfolio. This means 50% in stocks that can grow in value and 50% in bonds, which are loans to governments and large corporations that give you income. When you use this principle, you hope stocks will do well, you hope bonds will do well, and you hope both don't go down at the same time during a crash. The problem is stocks are 3 times more risky than bonds, so most have 95% stock risk when adjusting risk and returns. If stocks tank, the whole portfolio tanks, as will be a problem for many relying on a traditional pension for retirement. Stock and bond market correlation is also completely random. Sometimes they move together, sometimes they don't. The 2008 and 2020 crash showed that everything crashes together and the government is willing to give unlimited support to markets rather than let them move naturally and crash. When correlations break down, the portfolio could blow up. In 2020, Warren Buffett's Berkshire Hathaway famously recorded a massive $50 billion net paper loss after the coronavirus pandemic hit his stock investments. Normally, Warren Buffett would not care as he's long-term, but the difference this time is he started dumping some of his stocks rather than riding them out, even though the stock market recovered short-term on government bailouts. He holds huge positions in airlines and banks. Airlines were most affected by the lockdown, and banks, I predict, will take center stage in the upcoming financial crisis. Overexposure to stocks can even lead the most disciplined investors in the world to panic sell, so what hope do less accomplished investors have? So what's lesson number 2? Mistake number 2 is stock market overexposure. And therefore, lesson number 2 is build a portfolio to last in any season. In times of rising growth, stocks do great. But in times of rising inflation, deflation, and economic decline, they only do well when governments artificially prop them up through debt-based money printing programs like quantitative easing, which is never going to end well. Many consider stocks a hedge against inflation due to their historic performance. But in times of stagflation, where you have decreasing growth and increased prices, they will be hit hard. Overexposure to stocks at the time you retire could have disastrous consequences. Be ready for more eventualities than just rising economic growth or continued quantitative easing and government bailouts. At some stage, those will not work anymore. The second thing we will do with our retirement plan B clients is get them to define their exact mix of asset allocations and remove the emotion and subjective decision-making of when to buy and when to sell using multiple asset classes to prepare for all outcomes.
Okay, so the key lesson in lesson number 2, with terms of the mistakes and lessons from the greatest investors in the world, is stock market overexposure. Stock markets are now no longer markets. They are a function of quantitative easing. And so central banks are on one side of the trade, and then institutions are on the other side of the trade. Institutions are deciding whether they want to continue to invest in stocks and bonds based upon what the government, what the central bank is willing to do. So when inflation comes out of control, i.e. 6.2% in the US, and they start to announce that we need to try and control inflation, the market starts to react to that and recognizes that maybe the government might increase interest rates, and maybe the government might not, or the central bank may no longer support what they're calling tapering. And therefore you spook and you get corrections in the markets. Now, corrections in the markets, when I have what I call a retirement plan A, which is a traditional investment strategy, we'll cover a bit more when we go through that in Masterclass 3, then it's benefiting really from the growth and the belief that central banks are willing to take us away from free markets and move us fully into socialism and capitalism, because that is the future of markets now. Away from capitalism, more towards communism. So that is stock market overexposure. So if I'm not saying that you shouldn't have your traditional pension, you shouldn't have your traditional retirement plan. I'm saying that everybody needs a retirement plan B on top of their existing plan. This is plan B, and it benefits from the growth of Bitcoin and the world's largest wealth redivide that we've seen as a result of this. So what's the lesson here? What can we learn from since then? Well, there's been a new dynamic in the market that was when we go through the exact asset allocation. By the way, I sometimes use jargon and I forget about it. Hopefully we can cover those in the Q&A. But if you look at the key distinction between the wealthiest fund managers in the world, they really put it down to one thing: asset allocation. And that really is the game. The game is how you take your money and allocate assets. Well, what if you don't have any money? Then it is the game of making sure that you know exactly where you are, you put together a plan, and you spend less than you earn, and then you can invest the difference. Now, I appreciate if people don't have any income, then they're in a different level of problem. It's their job is to try and figure out how to get that income. But if you just chip away, this is just percentages. Whether we're doing this with $10, $100, $1,000, $10,000, $1 million, $100,000, $10 million, $1 billion, it's the same game. But then when you start to go to bigger numbers, you enter into liquidity issues. And so really, it's just percentages. And the game is the same for everybody. But people think that you have to have money to make money. No, you have to be willing to spend less than you earn, invest the difference, and play the asset accumulation game. But most people, they want to get wealthy really, really fast. So they end up trying to find some tiny little altcoin or something that's going to go up in crazy. And sometimes that works. But this is gambling. And if that's your strategy alone, and I'm saying there is a place in asset allocation for gambling, because it sometimes can drive in crazy, insane returns. We'll go through that more when we talk about altcoin overexposure. But don't make that your primary strategy for trying to get in the game. And so spending less than you earn, figuring out where you are. You know, when you think about when you're trying to get somewhere, think about a Google map. What is a Google map? Well, you need to put in several pieces of information in order to figure out where you want to go. The first thing you need to do is you need to turn on your GPS. And when you turn on your GPS, it says this blue dot plonks down and says, here's where I am. This is what you're doing when you're doing your assets. You're figuring out your balance sheet and your cash flows. And then once you know where you are, you tell Google, I would like to go over here. And so most people, they have no financial plan. They have no goal of what does it actually take to retire and climb what I call the financial ladder. Instead, they just try and, leave it to chance. Hopefully my pension will happen, or I save enough and these things will happen. But if you don't set the specific exact goals of exactly when you want to be there and how realistically can you get there and what are the projections and what types of risks you need to take in order to get there, then you never put the output. So once you say where you want to go, Google then drives this, puts together this line, and it tells you exactly how to get there. And that's exactly what everyone that we're looking to do this for is taking the spreadsheets, putting together their plans so they exactly know how to get there. Okay, so here's another dynamic that happened. So in the retirement plan B allocation that we talked about in video 3 that we'll cover in Masterclass 3, we talked about investing in private equity in order to take out some of the volatility in cryptocurrency prices. And so private equity is very different to public equity. And for the reasons that people hate private equity is the same reasons why it is a beautiful asset class to those that are playing the long game. Private equity does not have a liquid market, and therefore it's the forced hodl. If you don't know the word hodl, hold on for your dear life. It's a mantra in Bitcoin because it has served the saver saving those Bitcoins over the long term and over the cycle. Well, private equity is a forced hodl as well. It also evens out some of that volatility. So I invested a lot in the shares of cryptocurrency exchanges through BnkToTheFuture.com. Now, some of those are restricted to certain types of investors. So it's not a strategy for everybody. We're also applying for licenses to open it up to a broader audience. But private equity versus public equity has become a really interesting trend. With private equity, all of the venture capitalists are benefiting from everything that the companies are going public later and later and later. So at BnkToTheFuture, people were investing in Coinbase shares way before it went public. And then all the returns have been made from those that invested in the private equity, and some of them are considering exit once it goes public. Your pension, your retirement plan can only invest in those public shares because risk adjusted is the only thing that they can do. Now, this is a high risk, high return strategy. There are problems with private equity. You have to diversify widely, but investing in private equity versus public equity significantly outperformed, as we talked about the results that we're going to recap later today that we also covered in Masterclass 1. So when you're thinking about public equity, you're fiat thinking. It's the traditional stock and bond portfolio. When you're thinking about private equity, this is more along the lines and tokens. This is more along the lines of Bitcoin thinking. And the returns that can be generated. Obviously, this is where it's got to be very careful about giving financial advice, because this completely depends on when you want to retire, what your age is, what your liabilities are, what your debt levels are. And that's where you need to really bespoke down, work with a financial advisor, or take the tools that we take in the Retirement Plan B online wealth management program, put them together. Either give yourself, be your own financial advisor, or take those to your financial advisor. So stock market overexposure is something that you really need to think about in your asset allocation. And that is part of the Retirement Plan A, which fulfills different goals to the Retirement Plan B, as we'll go through in the third masterclass when we break down asset allocations. So now let's move over to the third lesson that we covered this time about a year ago, and that is gold overexposure. So let's head over to the video. Take it away, Dave.
Mistake number 3, gold overexposure. All the great macroeconomic commentators that have been forecasting problems in the dollar, banking, and the markets love gold. Every investor that has studied history knows it's an essential part of every portfolio. But some prolific investors use it as the only investment they hold alongside gold stocks and other assets that give them gold exposure. On the other extreme, high-profile figures that run our central banks believe it's an ancient relic that plays no part in our modern monetary system. I believe both are making big mistakes. Gold is an amazing store of value with 5,000 years of history, but its leading role as a store of value is about wealth preservation, not wealth creation. Wealth creation involves growth, income, and risk. Gold is not designed to grow your wealth or give you dividends. It's designed to maintain your current wealth and purchasing power with no income. Once you have wealth, feel free to do what the rich and central banks do. Preserve some of your wealth with gold, but don't let that get in the way of wealth creation and diversification. Too many gold bugs miss the ultimate chance to have more gold by ignoring more speculative stores of value like Bitcoin. Peter Schiff is a legend that got a lot right with regards to debt bubbles, banking crisis, and the importance of non-US stocks and currencies. But he missed out on Bitcoin and the US dollar asset bull markets, which he could have used to accumulate much more gold. Imagine how much gold he'd have if he put some of it into Bitcoin. Building your entire portfolio on a belief that the dollar will collapse and gold and foreign currencies are the only way to protect yourself may work out fine in the end, but not diversifying into Bitcoin and betting against the Federal Reserve has historically been a very expensive mistake, as you can go broke waiting for the politicians to get back to sanity again. If it leads you to not allocating some of your gold to the preservation of the existing system or more speculative alternatives like Bitcoin, it leaves you overexposed to one outcome only. Gold investors think the right way is being ultra cautious, but having all your eggs in one basket may be disastrous when you can't access your gold locked up in Switzerland or Singapore with a custodian, which will most likely be the time when you need gold the most. Because gold is hard to store on your own, this is where Bitcoin could become your life jacket. And one of the reasons I believe is demand will go up over time with a fixed supply, even if it does not have all the history of gold. It's been the highest performing asset for 10 of the last 12 years. Peter Schiff was right about so many things, but continues to remain fully exposed to gold stocks, and non-US currencies and assets, whilst being unprepared for any other outcome. So what's lesson number 3? Mistake number 3 is gold overexposure, and therefore lesson number 3 is to be prepared for other eventualities, as politicians can take this in many different directions and prop up the dollar for a long time. Diversification can be used to increase your gold position, even if that is your only end game plan. The third thing we will do with our retirement plan B clients is get them to use gold for what it is, a store of value, but use other asset classes like Bitcoin to maximize returns through income as well as growth.
Okay, sorry, Peter. Gold overexposure. Boy, it's been a rough year for Peter. Telling everyone to bet against the Federal Reserve and bet against Bitcoin. Whew. Don't fancy being on the wrong side of his portfolio. So I'll tell you what, just before we go through the next lesson as well, so let's do a quick review of what the different types of thinking. But I'd love to know from you, are you enjoying this content? I'm going to go back to all the tweets afterwards and read through the comments and read all everything there. But do me a favor, if you're watching this on YouTube, please like that video. Let's see if the YouTube algorithm can send us some love. I'm going to be teaching my heart out. I'm going to give all of my energy over to you, but I'd really appreciate if you could send a few tweets, if you could share with your friends, if you could like that video, give us a thumbs up so that we can get more people exposed. I personally believe that we are alive at one of the most interesting times in financial history, and I want more people to be on the right side of that change. So please, if you have friends and loved ones that would really like to see this message, then I'd really appreciate you giving us a like, giving us a share. And also maybe we can get Peter Schiff watching some of this, because we're about to go into Peter Schiff thinking. So maybe tweet him and we'll see if we can get him over in future episodes to come over to the Bitcoin thinking dark side. I know many people have tried, but he may be the very last person standing and then have to send all of his assets one day in his retirement plan over to his son, and then his son will go up and buy Bitcoin anyway, just like all of the next generation that are receiving the baby boomers' assets with their inheritance plans. Okay, so S&P versus Bitcoin versus gold. And so what I call here is the fiat thinking is that those people that were thinking about fiat were obviously paying the Fed. So institutions no longer care about whether stock markets should be up, whether it makes sense that they should be at all-time highs, whether the fundamentals make any sense anymore. They only care about one thing. Is the Fed going to inject more money so that the stock markets can be propped up? And so really, we have moved over to a complete central planned economy with no markets, as we said time and time again. So fiat thinking is all about, please Fed, please carry on so that my stock prices can go up. And Elon Musk even sold 1% of his Tesla stock today because he probably thinks the prices are high, plus his billionaire tax. And I'm sure he's going to go out and buy some of those Bitcoin with it, because he sure as hell didn't sell any of his Bitcoin, from what we can tell anyway. Bitcoin you would have held if you were Bitcoin thinking, and if you were holding gold is because you were Schiff thinking, and Schiff thinking wanted to bet against the Federal Reserve, and the Federal Reserve proved time and time, again, wrong, that they're willing to push and pump more money and remove the free markets away. Schiff is saying, come back to the free markets. It's a done experiment. This is the world that we live in today. If you want free markets, you need money that exists outside of governments. You need money, public blockchains. You need Bitcoin, which allows people to own their own money, spend their own money, and have a fixed supply that is not at the mercy of any central planners. It is the ultimate free market. It is manipulated like crazy short term, but manipulation is part of that. Anyone can manipulate. Anyone manipulates all of the traditional markets, but it doesn't have, it is the ultimate free market tool there. And he also thinks that Bitcoin is a Ponzi scheme with no utility. Own your own money, spend your own money, money with a fixed supply. That is pretty damn good utility. Legal tender in countries like El Salvador this year. Lightning Network getting attraction so that you can spend it without the large fees that happen on the Bitcoin main chain. And each and every year, countries realizing that owning your own money has utility and intrinsic value. Spending your own money has utility and intrinsic value. And having a hedge against the whims of central bankers and inflation has intrinsic value and utility. Okay, so gold overexposure. Having said that, gold does serve that hedge against what happens if there's a catastrophic failure in Bitcoin. So it's still part of the complete, unshakable retirement plan B and retirement plan A portfolio, but it's serving a different purpose. I'm not buying gold expecting to get wealthy. I'm not buying gold thinking this is serving a security need and is a preserver of wealth as it has been for the last 5,000 years. Okay, so now let's move over into lesson 4 and mistake number 4, which is bank overexposure. Take it away, Dave.
Mistake number 4, bank overexposure. Many investors' closest experience of bank failures outside of the history books was the 2008 financial crisis. Most did not suffer the consequences of bank failures as the governments and central banks added a few more band-aids and put off much of the inevitable and predictable guaranteed pain for later. Most experienced the hidden effects of taxpayers' money being used for bailouts instead, which was less painful to those that experienced bank bail-ins, where their deposits were simply taken from them, as happened in Cyprus. If you go back further in history, you will learn that no government currency in history has ever survived. So everybody needs to be ready for the inevitable. And even if it does not happen in your lifetime, the fact that investors are preparing for it has created some of the highest performing investments in history, such as Bitcoin, as it works without a bank. If you only invest in traditional markets, you are exposed to bank failures and you are taking excessive risks by not hedging into Bitcoin. Even if you're not sure about Bitcoin, those that put some of their funds into a plan B were able to significantly increase their wealth by holding the asset that works even if banks go belly up. Ray Dalio is the most consistent hedge fund manager at scale of all time. He builds his portfolios preparing for any eventuality and recognizes that nobody knows what is coming next, so he prepares for what he calls all seasons. This is why Dalio's portfolio consists of more gold and commodities than most other investors, because gold still works when banks fail. In video 3, we'll cover more on how I tweak the Ray Dalio approach when we go through the exact makeup of my retirement plan B. I do, however, believe that Ray Dalio has missed out on one big season. The one where banks fail systemically and globally you can't get hold of your physical gold in lockdown. Contrast this with another legendary hedge fund manager, Tudor, who recently announced that a fixed percentage of his hedge fund is investing in Bitcoin. He recognizes how speculative it is, but sees the opportunity for asymmetric, above normal returns due to the fact that, like gold, it works outside of the banking system. But unlike gold, it is easy to store without a third-party custodian, giving another season to be prepared for and the potential to outperform all other hedge funds that have not got Bitcoin exposure yet. Obviously, past performance does not equal future returns, but the earlier an investor has prepared for this, the higher the value of their returns have been historically, with the exception of 2 of the last 12 years. So what's lesson number 4? Mistake number 4 is bank overexposure, and therefore lesson number 4 is prepare for your cash at a bank to not be king. In times like this, most people dump their assets and go for cash. Money held at a bank is not riskless, not fully insured, and not yours. Compare that to Bitcoin, which is yours with no bank in the middle, can be spent without a bank, and its supply is fixed no matter how much governments print money to save banks. The 4th thing we will do with our retirement plan B clients is get them to prepare for all seasons, including bank failures and gold custodian lockdowns.
Okay, so this is another side effect of the fiat system. By giving banks the ability to create money as debt every time they issue a loan, in the world's largest regulated Ponzi scheme, you end up in a scenario where people are overexposed, people overlever, and you end up having to put all of that debt on the government's balance sheet or the Fed's balance sheet, and then they need to lower interest rates in order to stimulate more debt in these types of markets, until you end up with the situation we're in today, which I do not believe, I cannot find a moment in history where so much has happened, and why it is one of the most interesting and exciting times to be alive in financial history, because we are seeing the financial system transform itself, banks transform themselves in front of our eyes, and most people are just completely unaware of what's happening right now. And thanks to Bitcoin, when I used to go before Bitcoin and try to explain to people how banks create money and all that type of stuff, we never used to be able to get them interested. It was only until Bitcoin came around that people started to believe even that banks create money every time they issue a loan, and it became the information age, drove more and more people into consuming content just like this. So let's have a look at the bank overexposure. Where do we find ourselves today? Well, we find ourselves today, as I covered in Masterclass 1, in a situation where banks really don't want you to have deposits with them. They can't even sustain those the interest rates on those deposits because of the economy we find ourselves in today. So if you had money with a savings account, if you had it in your checking account, you received an average of 0.3% interest. If you had it in a savings account, you received an average of 0.6% interest. And if you put it in the money markets and bought some securities or different instruments, then you would have got 0.9%. And later, we're going to review exactly what we covered in Masterclass 1. So if you weren't in Masterclass 1, I'm going to head over where I go through directly all these different effects. Also, if you were in the Bitcoin world, then you might have taken some of that and you might have ended up with some stable coins. And stable coins were paying an average of 10% yield. So in an inflation-led world, where we're up now to 6.2%, before we were at the average was about 5.4% before the latest announcements in the case of the US, then you are actually losing money that you leave at a bank. Now that's okay. They provide some kind of utility to us. They allow us to pay our bills and various other things and put some money in security. But why do people put their money in bonds? So if they're putting their money in treasuries, or they're putting their money in longer term or shorter term bonds, they are losing money by lending money to the government. Why are financial institutions willing to do that? Where is all this demand for all of these loans and all of this money that governments are borrowing and lending, and you're investing in them? It's because of the credit risk of the bank. If you leave your money at a bank, you are exposed to money that they own, the credit risk of what the bank is doing, and whether they do bail-ins or bail-outs. So institutions are not willing to take that risk. So they'd rather bet on the risk of the government's credit rating. So even though they are receiving negative, they're losing money by investing in bonds adjusted for inflation in real terms, they're still willing to lend to the government. Why? Because it's not in the banking system once you lend it to the government. So it's a hedge against bank exposure. Everyone else is putting their money and thinking that there's bank insurance, but the bank insurance is only insured, like Federal Deposit Insurance, FDIC, only covers 1% of all the deposits at the bank. And so therefore, if more than one systemically significant bank goes bust, like we saw in 2007, the insurance isn't worth shit. You need bank bailouts, and you have the potential for bank bail-ins if they don't. And remember, we have not solved anything that led to the last financial crisis. In fact, we have levered right up. We took our economy and we are hooked on debt. We have really solved the problem with the cause of the problem and levered it up many, many times over. As we said, the only way to get out of this from now is the complete removal of markets and they're moving over to modern monetary theory, central bank digital currencies, and complete shifts to socialism and communism ideals in managing an economy. Anyway, so that's why people are still lending to governments, and that's why it's part of the traditional retirement plan A, because you're trying to hedge some of that bank exposure. Now, in the stablecoin market, you had different types of products. You had ones that are backed by dollars, ones that aren't backed by dollars, but on average, you were able to receive about a 10% return consistently. So stablecoins were the only place to put dollars. And I talk about dollars a lot because, as I remember in the trends in video 1 and in Masterclass 1, we talked about dollars, gold, and Bitcoin being the 3 pillars of how we think about how we navigate the monetary renegotiation, because one day the dollar won't be, but the dollar is still in a dollar debt-backed standard. So as investors, we need to do what wealth managers do. Wealth managers don't think in terms of their local currency. They take their clients' wealth and they think in terms of the currencies that are most important and significant in the global strategy. So if you're just using your own currency because you were born in that country, then this isn't what wealth managers do. This isn't what the top 1% do. So I want you to think in terms of these, start thinking in terms of how the rich and wealthy. What I've tried to do with all of this is take the strategies of the wealthiest 1% that, just due to different circumstances, I had the privilege of being around and meeting, and condense it into things that you can actually take away, put into place, and think about it in terms of your actual overall strategies. So savings account versus stable coins versus bonds were really, if you were fiat thinking, you were thinking about how to save, cash is king. If you were retirement plan A thinking, then you would be thinking about putting some of that bank overexposure away. And if you were Bitcoin thinking, then you might have been looking at hedging for bear markets and receiving yield in terms of real growth of your dollars adjusted for inflation, rather than what everyone else was doing, making a loss on those. And also, welcome Ray Dalio to the Bitcoin community. So not quite a full convert, very precautious about it, but he did tell everybody that he owns some Bitcoin. So Ray Dalio, to me, is the greatest hedge fund manager in history, with the most consistent returns, risk adjusted, with the lowest volatility, and outperforming most hedge funds. So we welcome Ray Dalio to the Bitcoin Club, but he does always believe, he does still say at this stage that he believes if Bitcoin reaches a certain stage, then it will go through that government ban and governments won't allow it. In Masterclass 1, we talked about the infamous government ban and how when China bans, Bitcoin reaches all-time highs, and now everybody has it in their pension and retirement plan through the exchange-traded fund, significantly reducing the likelihood of this boogie monster government ban. That was still is a risk that needs to be managed, which is why we don't put everything into the retirement plan B. This is all about asset allocation, unshakability, so that you're ready for inflation, deflation, hyperinflation, hyperdeflation, economic growth, economic decline, and you can just spectate, enjoy the markets, accumulate assets when they crash, and move into Bitcoin thinking where the returns have historically been made. And obviously, past performance is not an indicator of future returns, but for educational purposes, you can take that and start to, some of the things we do is look at some of the pricing models with our wealth management, with people like Saifedean Moose, who put together bonus content just for the Retirement Plan B wealth management program, so that we could model it through into their financial plans once they've done their assets and their balance sheets and cash flow statements, and putting together their optimum asset allocations depending on their situations. Also, we saw the FOMO kick off with Paul Tudor Jones. So Paul Tudor Jones, legendary investor. Back in the day when I was working in investment banking, I used to read books like Market Wizards with all of the real legendary investors. Paul Tudor Jones was one of my heroes when I was reading, hundreds of books on all the different legendary investors. And it's great to see them join us at the Bitcoin community as we progress. So as I said, sorry, this is... I actually tweaked the Ray Dalio strategy and adjusted it for the retirement plan B and put together what we call a retirement plan A. We'll go more into that in the third masterclass as well. That's one of the things, and really tweaking it for that 5th season, and how to put together. You can see a lot of the influence in terms of how Ray Dalio thinks, but I applied it to my retirement plan B, the crypto markets, and the wider and Bitcoin and various other things. So, welcome Paul Tudor Jones to the community. As we said, he was a legendary hedge fund manager, and when he made that announcement that he's put 1%, he started really, really cautious. And over the year, he gradually went, I'm underexposed to Bitcoin. I need more Bitcoin exposure. And it created off this incredible FOMO, fear of missing out, where all the hedge fund managers that are competing with Paul Tudor Jones's hedge fund said, oh no, if Paul Tudor Jones has got some Bitcoin in his portfolio and he starts achieving abnormal returns through his, as he did throughout 2021, then we now need to compete with that, because everyone's looking at what hedge fund to invest in based upon the returns. And so now we need to buy some Bitcoin just to compete with the hedge funds that own Bitcoin. And this drove people into not just a hedge fund FOMO, but then it started to get corporations, which was really driven by Michael Saylor from MicroStrategy, when he started telling the world that his public companies got some Bitcoin on the balance sheet. It was then followed by Tesla. This then followed by institutions figuring out. This then followed by the exchange-traded funds. We haven't got the real one. We got the Fugazi one in the case of dollars, but you still got the Canadian dollars one. And we still have so much further to go as an industry and a sector. And it's just been great seeing, just more and more people. Bitcoin's sucking up the world and people coming into the community one step at a time. And it was just really great to see. Welcome to the community, Paul Tudor Jones. Really great to see you here. You were a hero to me back in the day, and really glad that you decided to come over, and particularly Ray Dalio as well. And so now let's move over to the next lesson. Let my slides catch up. Yeah, the ETF, the fear of missing out, institutions, corporations, hedge funds. Let's see if I can get my slide to play game. We're now on lesson and mistake number 5, which may be a little surprising to you, but a really important one that often many Bitcoiners forget about, which is Bitcoin overexposure. So let's move into that one, Dave.
Mistake number 5. Bitcoin overexposure. Many people call me a Bitcoin maximalist. It's a phrase that came to be when thousands of cryptocurrencies were being created, and a label given to those that only believe in Bitcoin and no other cryptocurrency. But my approach is pretty simple. I believe that Bitcoin has unique properties that make it our world's best shot at ever achieving digital, hard, sound money, and nothing else in the cryptocurrency market competes with that. I'll explain exactly why in video 3, but if risk managed correctly, I won't let that belief stop me from increasing my Bitcoin position by putting a percentage of it into more speculative alternatives that can enhance my Bitcoin position in exchange for greater risks. There is one huge problem with this approach though. There is an ocean full of scams and people that want you to give them all your Bitcoin for whatever serves their agenda. The crypto scams are everywhere. It's complete buyer beware in the crypto market, which is why for most, Bitcoin maximalism is a lower risk and easier approach when entering the market. If you are a Bitcoin maximalist, however, over the last decade, I've learned 2 big lessons from those that were there from the early days of Bitcoin. Bitcoin maximalists missed out on opportunities to radically increase their Bitcoin position by applying their belief about Bitcoin to their investment strategy and ignoring the wider crypto market. In video 3, I'll share with you exactly how I manage this risk to optimize my Bitcoin position as part of my retirement plan B. So the first mistake was ignoring the wider crypto markets. The second big lesson I learned from Bitcoin maximalism is that some held all their wealth in Bitcoin and little in traditional currencies. After all, traditional currencies lose value over time and mean you have to beg banks for your money, right? Well, yes, but I never held everything in Bitcoin because I saw a huge mistake made by many early Bitcoiners. They ended up having to sell their Bitcoin at unfavorable prices and lock in losses because they were trying to meet their everyday living expenses with their Bitcoin. Selling Bitcoin early has cost a lot of people a lot of wealth, and it's because they were relying on short-term gains in Bitcoin to meet their living expenses. Every year, we celebrate Bitcoin Pizza Guy, who spent 10,000 Bitcoin on 2 pizzas, and these $100 million pizzas are legendary. Everybody in Bitcoin has their own version of the Bitcoin Pizza Guy story. But it's a sad fact that many early Bitcoiners never became wealthy for this one reason: poor money management. Tone Vays is one of the most vocal Bitcoin maximalists in our industry. We shared a panel stage together in Hong Kong when he first became a public figure in Bitcoin, and I've appeared on his show many times over the years. While we are very philosophically aligned on many things, using the Bitcoin maximalism ideology and applying it to your investment approach leads you to not taking advantage of the extra Bitcoin you can generate from the wider crypto markets. Even worse, it can lead you to having to sell your Bitcoin early just to meet your living standards. But I want to be crystal clear here. Putting all your Bitcoin into alternatives in the crypto sector is a suicidal strategy that has ended up disastrous for many. But not following a risk-managed approach to enhance your Bitcoin position using the crypto markets has been make or break for many I've met over the years. Some gambled it all away, trading leveraged cryptocurrencies, investing in ICOs, investing irresponsibly or in scams, while others use the crypto markets to end up with a life-changing amount of Bitcoin in their control, ready for any outcome and all living expenses covered forever. So what's lesson number 5? Mistake number 5 is Bitcoin overexposure, and therefore lesson number 5 has 2 parts. Part 1. Don't make the mistake of ending up with no Bitcoin because you gambled it all in the alternative cryptocurrency market. Part 2. Don't put yourself in a position where you have to sell your Bitcoin to meet living expenses, gambling on its short-term price. Use traditional finance and currencies to ensure you don't have to sell your position, because Bitcoin fluctuates like crazy, and I don't see that stopping anytime soon. The 5th thing we will do with our retirement plan B clients is get them to separate money for their living expenses and security from their investment portfolio and use risk and money management principles to maximize returns while fully understanding the risks and preparing for all outcomes. They'll know when to buy and when to sell without any subjective decision making.
Okay. If you only get one thing out of this live masterclass and you ignored everything else and you just took one thing away, this would be one of those things. Separate your investment money from your spending money. When your spending money is the same as your investment money, you will be driven into the same mistakes that 90% of the people out there make, which is they think of their investments in terms of what it can buy them initially, and therefore they have to sell their investments in order to meet their living expenses. This is because poor money management. This is just exactly what professional fund managers do better than anybody, is they fully understand the game of money management. And it applies to Bitcoin, it applies to the crypto markets. So I don't make myself overexposed and trying to invest in one altcoin and grab the Shiba Inu coin or the Doge coin and hope that it goes up like crazy and then try and figure out what I'm going to buy with it. This is exactly what almost everybody is doing. And if you take just one thing away, it's please spend the time thinking about planning how you decide how much to put into these crazy gambles, how much to put into your Bitcoin, how much you're going to be, and how to separate your spending money. So many people that I met, they were at the, since being involved from the first Bitcoin conference, that are not wealthy because they had to keep selling their Bitcoin to meet their expenses as they go because of just pure, poor money management. Some of the most influential people in this industry, I know, I would never talk about that, but I know many of them that have made those mistakes behind the scenes. At the same time, being, the conservative approach is the Bitcoin maximalism. But if I didn't put some of those Bitcoin into the Ethereum ICO, that would have had a radically different effect on the results that I ended up achieving. And we can look back and we can all say, we can also talk about exactly what we should have done, right? So if we could look back in history, we'd say I would have taken some of my dollars or pounds and I would invest it back in 2009, 2010 in Bitcoin mining. I then would have taken some of those and I would have put it into the Ethereum ICO. And then when the market was all crashing, I would have put it all into all of these digital tokens. And as the ICO market started crashing, I would have put it into stable coins. And then I would have taken some of that stable coin and I would have bought Binance token. And if I bought Binance token and then it had exponential returns, and then I start putting it back into Bitcoin when Bitcoin was outperforming all those. And everyone could just map it out. And if you did, you'd be a trillionaire and you'd be on the same level as Jeff Bezos at this stage. But nobody does that because everyone tells you about their winners and no one tells you about their losers. I've had a mountain of losers over this time. It's the private equity game. The private equity game is invest in 10 companies. One of them goes incredibly well, like the Krakens and the Bitfinexes and the Bitstamps and the Coinbases and the blockchain.coms and the Circles and many other the unicorns that we've had allowed investors to get exposure to at BnkToTheFuture.com, and the rest dawdle along or go bust. And that most people are putting all and everything into one, or they're just looking at doing the conservative approach, which is going for Bitcoin maximalism. Now, Bitcoin maximalism is, I think, a sound principle, and I think it will serve people well to do very well. But it's a shame that they're not using sound money management that would allow them to accumulate more Bitcoin. Just like if Peter Schiff was using sound money management, he'd have a lot more gold right now if he put some of it into gold for all the reasons why he's telling people to buy gold, to buy non-US dollars, and to buy foreign stocks. So the retirement plan B is designed to really manage this out as part of your financial plan, and it builds upon and top of each other so that you don't end up overexposing yourself to these different things. So, for a little bit of fun, everyone knows that if they invested in Dogecoin this year, they probably would have done and significantly outperformed all of the Bitcoin maximalists. If you had invested in Ethereum, and I still hold some Ethereum, and that's part of the retirement plan B approach, we're going to move over to a video shortly at the end of this before we move into the asset protection section and the tax section and various other things. And before we start taking some questions and get some questions from the audience. If you were Bitcoin versus Ethereum, and Ethereum was part of the retirement plan B portfolio, you might have put all of your money into a DeFi scam that went down 99% or got hacked or something like that. And I know people, they lost all of their ether because they put it into a DeFi scam because they were betting all on one outcome. It's gambling. Ethereum outperformed Bitcoin. Bitcoin is the conservative, hard, digital sound money. Ethereum has a lot more risk. We don't know what's going to happen when they move over to fully integrating proof of stake and Ethereum 2.0 and all that stuff. So expect to get higher returns. If you put it in Dogecoin, which really just is nothing but Elon Musk now, you would have earned incredible returns. If you put it into Shiba Inu, and then people see that as saying, right, all my money should go over there. So that leads us really over to the next lesson, other than Bitcoin overexposure, which is the final lesson, and that is altcoin overexposure. And this is exactly the cycle that the amateurs go through. They come along, they see all this money of this $3 trillion market or whatever it is. We've had a bit of a correction at the moment. They freak out during the panics. They FOMO in during the good times. And they try and find that one tip, that one guru, that one YouTube influencer that's going to tell them what to buy before everyone else. They put all their money in it. They either do incredibly well and then start using sound money management and implementing some of the principles from the retirement plan B, or they end up gambling just like 80% of national lottery winners. Within 2 years of winning the lottery, they end up in the same financial position as before they won the national lottery. It's because they never learned the money management principles, asset allocation principles, and many of the things that we're covering in this whole retirement plan B that I would love for anyone. Just take away some of these lessons. And if it gets you thinking in a new direction, then mission achieved with this live masterclass as well. And so we're now going to move over to the final lesson and mistake, which is altcoin overexposure. So over to you, Dave.
Mistake number 6, altcoin overexposure. A hard fork is when a developer takes the open source code of Bitcoin or any other cryptocurrency, copies it, and launches their own version. This is why there are thousands of cryptocurrencies, and it confuses the hell out of most people. Some mistakenly think that the supply of Bitcoin is not fixed because alternatives can be made. This is an understandable confusion, but incorrect, as there is only one Bitcoin. Just like there is only one internet, one gold, and a bunch of alternatives like the dark web and silver that are used for other purposes. Bitcoin is unique because it has no person, entity, or agency connected to it, giving it commodity-like features. Its records of every transaction are backed up on more geographically diversified computers than any other cryptocurrency in the world. It's got more distributed computer power behind it than any other crypto, making it almost impossible to take down no matter how much money a government has, and its security is unrivaled by anything else. It's the only cryptocurrency where you can rely upon the fact that it will never change its supply or be influenced by a small group of people. It's definitely got problems like its inability to change, but this is also its strengths, just like gold's inability to change. This is why I believe Bitcoin is unique and the world's best chance we have at ever achieving global, digital, sound money with a supply more scarce than gold. Roger Ver was the first person in the world to invest in Bitcoin companies and publicly supported the industry's growth in the early days when nobody cared and it needed him the most. I've hung out and debated with him many times, and I'll forever be thankful to him for supporting our industry when it was needed the most. But putting all your eggs in one basket and betting on a hard-forked version of Bitcoin becoming the real Bitcoin is a risky move. I'll never know if he sold all his Bitcoin to put it into a hard-forked version of Bitcoin, and my guess is that he has most likely protected enough of his wealth by keeping a lot of Bitcoin. But betting everything on alternative Bitcoin killers could be a destroyer of wealth, as it has for many I've observed over the years. It leads you to always chasing the next Bitcoin killer and missing out on Bitcoin itself. It drives people to trading in and out of cryptocurrencies based upon emotion and can lead you down a dangerous path of doing what many in the cryptocurrency markets do, gambling all their Bitcoin on the next Bitcoin killer and ending up with no Bitcoin and a huge tax bill if they don't manage their tax affairs correctly when trading. It also makes inheritance planning a lot more difficult when dealing with so many different accounts, and there are much smarter ways discussed in video 3 of getting exposure to the growth of Bitcoin alternatives, like investing in the equity of exchanges that make all the money from traders. So what's lesson number 6? Mistake number 6 is altcoin overexposure, and therefore lesson number 6 is don't let your ideology leave you with no Bitcoin. If you believe that there is going to be a new Bitcoin killer that takes over Bitcoin, this may cost you big. So the retirement plan B puts Bitcoin at its center, even if you think an alternative will take it over as a hedge against your belief being wrong. It also uses portfolio rebalancing to back your beliefs about alternative futures without putting everything on the line, and leaves you less exposed to tax mistakes that have cost some I know all of their Bitcoin. So there you have it, the 6 biggest lessons and mistakes I've learned from 7 of the biggest investors and high-profile figures in the investing and Bitcoin industry. Robert Kiyosaki, Warren Buffett, Peter Schiff, Ray Dalio, Paul Tudor Jones, Tone Vays, and Roger Ver. The overall lesson? Putting all your eggs in one basket means you have not prepared yourself for all outcomes. Trying to beat the markets by trading in and out is almost always a wealth destroyer and can cost you all your Bitcoin in tax if not managed correctly. I want you ready for inflation, ready for deflation, ready for depression, ready for growth, and ready for a banking breakdown without all the pain of timing markets, trying to buy low, trying to sell high, or risking it all on one bet. Do that and you can relax, have less financial anxiety, and help others less prepared for whatever comes next after the Great Depression of 2020. You will also have enough reserves to take advantage of bargain opportunities when markets crash and use that to accelerate the wealth generation process. As we get ready to reveal the full Retirement Plan B strategy in video 3, please remind yourself of the principles from video 1 and make sure you go back to video 1 if you have not absorbed them or watched the video yet. Remember the lessons and mistake in this video, because in video 3, I'll share you exactly how I combine all these lessons and mistakes together. Also, remember in video number 4, I'll share with you how to join me building 2 Retirement Plan Bs live. One with $1 million of my personal savings and another with no savings but a percentage of my income. Don't worry, you can follow along with any amount of money too.
Okay, so that's the last lesson and mistake. Hope you're enjoying it so far. Just as a quick reminder, if you're new to this, head over to retirementplanb.com if you would like me to answer your questions directly. That's the only place where we're actually taking questions. And we're going to be doing lots of sessions over the next week or so. And we're going to have sessions where we cover a lot more of your questions. We'll be going back to those as well. You can upvote other people's questions. And if you're watching this somewhere on social media or YouTube, then do us a favor. There we go. Azad is showing you. Head over to retirementplanb.com and you can start asking your questions. You can upvote other people's questions if you don't know what to ask. And we'll be taking those questions shortly as well. But I've still got a lot more content. The biggest risk here is that I've just got too much content that I want to share with you. And I hope that I'm not overwhelming you with too much information and that this is digestible. But I just really am passionate about making sure that you have what you need to take this in place and hopefully just a few nuggets that you can take away to do things slightly differently. Also, if you're enjoying this and you appreciate the fact that we're giving you this all completely free, then please do like, please do share. You can see the sidebar there. Hit that Twitter button. We're trying to get our message out to as many people as possible, and your support is needed in order to do that. So please do that, and that would be really, really appreciate, so I can have more energy to give you more stuff, and your comments and questions are really going to drive us. So let's cover the new lessons and a bit more content on altcoin overexposure. And let me give you some lessons from somebody that's been there and done that and seen everything there is to see in crypto. There's new things, but they're just iterations of the same things that we've already seen in the past. Most people think that everything that's happening right now is new because there's such a young, engaged audience that may not have been involved in many of the same things, like collateralized was just simply a concept from traditional markets that was applied to crypto, but based upon digital hard sound money as Bitcoin as the base layer and everything that was built upon top. So let me give you some experience from somebody that has seen everything from when there was only one cryptocurrency, and that was Bitcoin, through to where we have tens of thousands of cryptocurrencies where we are today. And this is why, when you're thinking about some of the lessons that we're going to cover in the second half, like tax efficiency, asset protection, compounding effects, I'm going to go through all of these today, and we'll try to see how far we can get. I might need to build upon it in the next session on Monday when we do Masterclass 3. But when you're thinking about it, you need to have a longer term approach. And this is why altcoins are so problematic when you're thinking about things like retirement planning. So let me take you all the way back to when it was only Bitcoin. I was speaking at the first Bitcoin conference. I launched my book, Bank to the Future, Protect Your Future Before Governments Go Bust. I don't need you to buy this. You can buy it as a memento if you want from Amazon, but you can have it for free as well. For everybody that joins this, we'll send out an email at the end where you can get a downloadable PDF version. Unfortunately, I got no idea how to send the books for free, but I'm sure you are okay with that in the digital age today. So I'm not trying to push you into the book, but I'll take you way back there. Went to the first Bitcoin conference, and it was us versus the banks. We were all talking about how Bitcoin was going to the cypherpunks, and I was the only finance guy there that was discussing how it relates to banking. And we were all talking about how, and I was trying to share with people what Bitcoin means and how the impact it might have in the future. Then suddenly came along a guy called a few guys, but one of the prolific one was Charlie Lee. And he said, well, let's create something faster, cheaper, and better than Bitcoin. And then suddenly everyone was talking about how 2011, you've got to have some Litecoin. You've got to have it. It was like silver to Bitcoin's gold. Is faster, is cheaper, is better. And then we started having this concept of an index of cryptocurrencies. So then you fast forward to 2012. And in 2012, it was all about creating a cryptocurrency that the banks could use. It was founded by a guy called Jeb McCaleb, and the token wasn't called XRP at the time, it was called Ripple. And everyone thought that they were investing into the company. It was founded by the same guy that that sold a cryptocurrency exchange called Mt. Gox to a guy called Mark Capellis, and there was 80,000 Bitcoin missing that led to one of the most ginormous catastrophic events in crypto that almost led to the destruction of Bitcoin in the early days when we really could not see our way out of that mess. But everyone was talking about how you got to have some Ripple in 2012. Then we started seeing this concept of coin market cap. I'll try and move around a little bit here. Sorry if it doesn't quite work. The lighting's over there. But coin market cap, and everyone was talking about how you've got to have Namecoin. You can put domain names and unstoppable domains, and Namecoin was the thing that you had to have in 2013. And then we started having these websites listing and ranking. You had Peercoin, you had Namecoin. Where's Feathercoin? I can't remember. I haven't seen that in there. TerraCoin, DevCoin, NovaCoin, all these ones. And so if you were thinking about retirement planning and you were thinking about compounding effects and you were thinking about asset protections and asset allocations, you need something consistent that sticks in the top 10. So now let's look at what happened in 2014. Well, in 2014, it was all about Mastercoin. Remember Mastercoin? They came along and they raised funding from the Bitcoin community, and they did the world's first ICO and token sale that was built upon Bitcoin colored coins. And everyone was excited about building coins on top of the Mastercoin. It's now known as Omni. Here we are, number 5. They had to rebrand it as Omni. This is where you were able to buy, launch tokens on top of Bitcoin, and we could fill all those use cases. And it was all about Omni. Now notice how the top 10 looks very different to what it did last year. So then we move forward to 2015. In 2015, everyone was telling you, Josh Garza is one of the guys that launched this amazing thing called Paycoin, and he was selling all these mining contracts, and everyone had to have Paycoin. And Paycoin was sponsoring the Miami Bitcoin conference, and everyone had the Paycoin t-shirt and the Paycoin caps, and everyone was talking about Paycoin. And then it hit the 10, and it's number 4 in the cryptocurrency market cap. Paycoin was a new thing until Jeff Garza got arrested for running a scam. Oh shit, Paycoin's no longer in the top 10. Then we move forward to 2016. It was all about, Darkcoin. Darkcoin, anyone remember Darkcoin? It was originally launched as Xcoin. I think it was, I've forgotten his name now. Aaron Duffy or something like that. If you're in the live chat, let me know who was the founder of Xcoin that later became Darkcoin that then rebranded as Dash. And then Dash is now in the top 5 cryptocurrency. Oh, where's Paycoin? Where's all the others? Where's Omni? Oh, they're no longer there. So then we move forward. They keep rebranding themselves, and they're associated with one influential figure, and everyone looks up to the guru and the owner and says, well, what are you developing? What are you going to do? And then they get upset when it falls out of the top 10. Then we move over to 2017. And in 2017, a bunch of people put their Bitcoins back in 2014 into Ethereum. Full disclosure, I was one of those people. They invest in the Ethereum ICO, and then Ethereum starts to build out the Omni killer, the Mastercoin killer. Everyone starts, and then suddenly in 2017, Ethereum Classic comes along, and Ethereum Classic is the real Ethereum. Ethereum Classic is the one that doesn't fork off the chain because a bunch of their friends got hacked from their Ethereum due to a DAO illegal securities scheme that ended up getting hacked and losing $60 million for people. And so Ethereum Classic was the real Ethereum. And then we move into number 6 on the coin market cap. Oh, but what about all those other ones? Where's Paycoin? Where's Omni? Where's all those other ones? They were the future. Then we move forward to 2018, and it was all about Bitcoin Cash. Bitcoin Cash comes along, and Bitcoin Cash forks off, and we had the debate around, how you should scale Bitcoin, and it was a very stressful time in Bitcoin's history where it reached a stage, And everyone came along and said, Bitcoin Cash is the real Bitcoin. Bitcoin Cash is the killer. And a bunch of communities split. And if you put your money in Bitcoin Cash, if you were listening, suddenly it was creeping up. And those that took their Bitcoin, took some of their Bitcoin, put it into Bitcoin Cash. They're the new number 4, cryptocurrency. And we had other ones like Tron, and Justin Sun comes along and says, oh no, Tron is the guru. And then Ethereum Classic, that was meant to be Charles Hoskinson. And suddenly now he's launched Cardano. What happened to Ethereum Classic? You were part of Ethereum, then you were part of Ethereum Classic, and now you're part of Cardano. And Cardano was originally started, it got a lot of trouble because it was sold in Japan as an MLM Ponzi scheme. And then it got rebranded later as Charles Hoskinson joined the project. And I remember, what the hell? I remember seeing it. I was sat at a conference with Roger Ver at the time, I remember, in Vietnam, where Cardano was this coin just for gambling. And it had a lot of trouble because it sold all this MLM scheme to all these Japanese investors. And there was outrage in the community. But then we repackage it, and then suddenly it's the most important thing in cryptocurrency today. So Bitcoin Cash was going to be doing it. And then suddenly in 2019, EOS was going to be the Ethereum killer. Ethereum is going to be dead. EOS is a centralized version. We can do things cheaper, faster, better. Everyone needs to have EOS. Everyone needs to invest. In fact, billions of dollars invested into the EOS token sale. And now it's trying to be revived and turned around because EOS is looking at Polkadot and Cardano and all these things and saying they're getting a lot of attention. We raised billions and billions. Now we need to try and revive it and do something. And the top 10 looks completely different all of a sudden. Now we move forward to 2020. And in 2020, it was all about Bitcoin SV. So Bitcoin Cash said, oh, Bitcoin Cash is the real Bitcoin. And the community at Bitcoin Cash said, oh, no, hold on. We've got Satoshi Nakamoto. We've got Dr. Craig Wright. And Dr. Craig Wright says that that's not how you should scale Bitcoin. Let's create Bitcoin SV. And Bitcoin SV is the real Bitcoin Cash. And Bitcoin Cash is the real Bitcoin. And in 2020, now everybody's bowing down to the guru of Craig Wright saying, please make Bitcoin SV happen. Please make Bitcoin SV. And you end up with all these different things. And the top 10 of cryptocurrencies change. And everyone was saying, no, we need to have privacy. It's Monero. And everyone's looking at Ricardo. Ricardo, I'm sorry for what happened to you. I hope everything works out okay. But everyone just bows down to these gurus that are the creators of the cryptocurrencies. And if they do something wrong, then everyone realizes that these are all just centralized, securities that are not recreating what Bitcoin created. And there's a lot of fun you can have with them. If you have an allocation, here's the problem with it, is no longevity in any of this stuff. Now, Ethereum was a freak one that created the utility, and it rewarded exponential returns to those that took some of their Bitcoin and put it into Ethereum. But it was money managed, it was risk managed, and it was asset allocation. And so if I say to you, one thing to take away, money management, asset allocation, thinking about it, spend less than you earn, invest the difference, and take some of these principles and stop gambling everything into the next Bitcoin killers. So there you go. And now let's move to today. So where are we today? Of course, sorry, this is white screen. It's going to make me a bit dark. But obviously, stable coins have proven themselves. Ethereum has proven himself as a protocol, massive adoption and traction. Bitcoin has proved itself as digital hard sound money. But what's the next Ethereum killer? Of course, it's Cardano. We've all got to have Cardano. Oh no, but Polkadot is the next Cardano killer. Oh no, but now we're on Solano, and we've all got to have Solano. And USDC is going to take over Tether because Tether's going to blow up. It's a Ponzi scheme scam. And then you end up with this whole thing. And XRP, now we need to start looking at how XRP, and full disclosure, I am a shareholder in the company Ripple Labs. I do not own XRP myself, but the company owns a big majority of the supply. So I try to disclose things, full disclosure, whenever I can. And the same thing happens time and time again. Each year, the top 10 looks completely different from the next top 10. What does that mean? that means you can't really benefit from the asset protection, money management principles they'll be sharing in the second half of this, because all you can do is try and get on the right side of that 1 year trend and try and get to the next one and the next one and the next one. What behavior does that drive you to? The exact behavior that is the opposite of what professional money managers are doing, and the thing that changes your wealth, which is why in the online wealth management program, we focus on, here's an allocation where you can do your gambling, go away, play, but make sure you're going to be trading, you're going to be creating taxable events, make sure you're recording everything as we go through in the second half, because you're going to be creating a tax nightmare for yourself. And when you get on the wrong side of those trends, you could blow up that whole allocation, or it can be a life-changing amount. But you are gambling, and make sure that you're following a sound money management principle longer term. And guess what? The returns are absolutely insane historically from being involved in Bitcoin. And when you actually map that out and chart that out, you can see that you don't need to do any of this stuff. You can do it for fun if you want. And sometimes I do it for fun. I'm constantly trying to stay up to date with all of this innovation, but there are really simple things. So in Masterclass 3, I want to give you the simple strategy, the simple approach. And then if you want to go complicated, probably doesn't make you any more money, but you do it because there's a psychological need to think that you got to find that next thing that no one's discovered, or the price of Bitcoin just feels too high and I got to find that cheap thing. And it's all an illusion. It's all complete psychology 101 that when I was a market maker, we used to use to really manipulate prices. And one of the reasons why I left the investment bank, because it just didn't feel like fun anymore. Okay, so there you have all of the lessons. So my principle, my asset allocation is just real simple within the retirement plan B. Bitcoin is the world's best shot we have ever had at ever achieving digital, hard, sound money. Despite thousands trying to do it again, they never succeed. Ethereum has really built an incredible community of developers, all building decentralized financial products and trying to rebuild different things, but it comes at a much, much higher risk than Bitcoin, because there is still dependency upon key figures and key gurus. It's not like Bitcoin, it's not commodity-like features where there's no one to go to. And because of that, you expect higher returns because you're taking a significantly higher risk. And altcoins are really you purchasing them in order to gain some kind of utility, depending on what it does, or taking a percentage of the money that you're willing to gamble with and trying to get those absolutely crazy returns, like we have seen with absolutely useless meme coins like Dogecoin and Shiba Inu. And sorry, I'm picking on those if you're from the community. But you know, you'd expect to get higher and higher returns. And people say that and say, well, I need to be in the highest return thing. And that's because they've got useless money management and they're going to get wrecked. And they're the same person that won the national lottery. And in 2 years' time, they're back to the original financial position. I don't want that for anyone. And if you take that away, money management, putting together a plan, thinking about this more strategically, thinking longer term, I think that's the key to achieving all you want financially. It worked for me. And it worked for Michelle, and it's worked for many of the other people on the Retirement Plan B online wealth management program that are implementing these things, and they're just unshakable. And they're not concerned about all these, when the price is crashing, when the price is going up, or what the next big, nice, shiny object and who the next guru I need to listen to is, because they know, here's my pot for fun, here's my pot for my retirement plan, and here's what happens if all of these different eventualities happen. And that's what I originally set out to achieve when we released that 4 3-part video series. Right, so I think now that took way longer than I thought. I always overestimate and I just keep talking and talking. But Azad, I think it's time for us to take some questions now. Dave, hopefully the earpiece is working and is connected. If not, if you make sure that's connected. Azad, should we do a screen share and pick out the top 2 questions before we move to the second part of the content which is on some of the cryptocurrency taxes and protections you need. This was strategically done. Build and protect your wealth. Build is about understanding the lessons, and then you move over to protection, which is exactly what the wealthiest people in the world do, and start focusing on the protection side. Azad, can you hear me?
Yep. So this
awesome.
Been,
I can hear you through the earpiece. It's working.
Yeah, this has been quite a popular question. So how do I apply to join in one of the 500 spots?
So after Masterclass 4, we will be opening up for the 500 people, and it's just simply first come, first serve. So we did the same last year. They won't go all immediately. You don't need to go into a mad frenzy or anything. We'll be opening it up for 5 days. But then once Sunday is over, the next Monday, we're starting the masterclass. You know, I'm going to be teaching out. If you are not in a position to do that, it does require an investment. We'll be the 500 people that register will be the ones that will be joining, and that will be open for registration after Masterclass 4, which will be next week.
Okay, next question is from OZ Jockey. If you keep the majority of your crypto holdings on Exodus or a hardware wallet and don't trade, what is the likelihood of any jurisdiction taxing your assets?
So this is a question of, can I get away with breaking the law? My answer to that question is that it is illegal to do that. If you need to pay tax on those assets, then you need to pay tax on that assets. So why not use legal asset protection? And we'll go through some of that today, and we'll be going through that in number 3. But personally, I like to sleep okay at night, and I don't want to worry about whether some government agency is going to find out some assets because they subpoena an exchange, and then they do some blockchain engineering and chain analysis and find out that there's a bunch of assets over here. I personally, it's just not something I want to do. So, but there's legal ways of doing that. And that's what we'll be covering here today. So if you're asking me, what are the likelihood of you getting caught doing, you know, illegal tax evasion, then my answer to you is that just do it legally. I personally prefer paying some tax. I don't like paying no tax, but if you want to pay no tax, and you have to move to jurisdictions and you're going to have to plan your affairs. And that was an option that some of the people took from the Retirement Plan B Wealth Management Program. We did a whole section on relocation and doing everything legally, understanding whether there's wealth taxes or any exit taxes and various other things. And we had our tax advisors come in and share some of the different jurisdictions and various other things that you would need to consider as that. But personally, I am just not a fan of you know, being in a jurisdiction where you have to pay some of those taxes and then not paying those taxes because you think it's, I mine some Bitcoin and then put it through Monero and then put it through a coin join and hold them in a self-custody and then put it in a crypto, whatever it may be. You know, personally, my approach is to not break the law, but use structuring in a smart way, and we'll go through more of that. So that's the 2 questions we've got time to take. And we'll go into more questions as we go through as well. So brilliant questions. Thanks for that. Right, what have we got next? So we did the next 2 questions, and I said we're going to be doing more sessions where we spend a lot more time on these questions. We'll be going back to these questions. So make sure you're upvoting other people. I just wanted to get the bulk of the content out there, and hopefully I can learn from this and try and deliver a little less content in Masterclass 3 and Masterclass 4. But we did say that we'd be scaling down the amount of content and really focusing on your questions as we progress as well. And remember, if you want to get those questions asked, you have to go to Retirement Plan B and you have to use the board there underneath the videos. And you can upvote other people's questions. That's the only place that we'll be going to, is a little carrot and stick, because we want you to leave your email so that we can notify you. And you know, if you're looking to be one of those 500 people when we open after the Masterclass 4, then we'll be notifying you by email so that you can come on that and join. Okay, so I think we're into the final video now, which is where we do the recap. And this was the closing part of video 2, where we summarize all of the principles, all the lessons, and I try to, whenever I'm teaching, make sure that we have time to recap so that you can cognitively make sure, and repetition is the mother of all learning. So now let's move over, Dave, to the recap video, and then we can move into the second segment on the asset protections.
So before we get to that, here is a recap of all the principles, lessons, and mistakes from videos 1 and 2. Principle number 1. Retirement Plan B prepares you for the US dollar continuing to be at the center of the global financial system after the monetary renegotiation. Principle number 2. Retirement Plan B prepares you for gold being important when the US dollar experiences troubles. Principle number 3. Retirement Plan B prepares you for Bitcoin being more important when banks fail and you can't get hold of your physical gold. It allows you to own your own money, spend your own money, and benefit from a fixed supply. When the monetary renegotiation happens after the Great Depression of 2020, these 3 principles should have you prepared to learn from the 7 most successful investors and high-profile figures covered in this video. Mistake number 1. Don't be overexposed to debt no matter how good it seems. Be a lender rather than a borrower. Mistake number 2. Don't be overexposed to the stock market no matter how cheap it gets in the next crash, and understand risk-reward ratios. Mistake number 3. Don't put everything into gold because you think the world is going to end. Mistake number 4. Don't be overexposed to bank failures by believing that cash is king, dumping all assets in a panic. Mistake number 5. Don't be overexposed to Bitcoin and end up selling too early to meet living expenses or miss the opportunity to enhance your Bitcoin position through a risk-managed approach in the wider crypto markets. Mistake number 6. Don't bet everything on the next Bitcoin killer and end up with no Bitcoin. So now you have the 3 principles and the lessons and mistakes of the most successful investors and high-profile figures in our industry. I'll see you in video 3, where I'll finally reveal the Retirement Plan B strategy and how I'm using it in the Great Depression of 2020. So keep an eye on your inbox and whitelist our emails so you don't miss a thing. Please leave a comment below, as I'd love to hear your investing lessons. And once done, share this link with your friends and loved ones, as I believe everyone needs a retirement plan B in the Great Depression of 2020. So for now, remember, no matter how bad it gets, you are alive at one of the most interesting times in financial history, and I want you to be on the right side of that change. Thank you.
Okay, so congratulations. We've got through all of the lessons and mistakes from the previous videos, and we've given you all the updates. And now we're going to move over to a bit on the side of the asset protection. And so remember, the retirement plan B approach is all about build and protect. So once you've built, your energy really focuses on protection. And so we're going to go through some of the considerations and things that we do and help you understand that you don't need to take some of these excessive risks that I've seen people take that end up blowing up their whole wealth by getting into the wrong pump and dump scheme and all the other stuff they see in crypto. We're going to be finishing at 8 o'clock on the dot. So I'm going to get through the content. I was going to give you a recap of some of the return on investment that I covered in Masterclass 1 on the return on investment that's been achieved by Retirement Plan B. But we've run out of time for that, so I'm going to go through. But don't worry, if you go back, if you didn't watch Masterclass 1, go back over the weekend, binge, get the content, play full out. I want you at the end of this to have all the tools and everything you need to really go out there and build your retirement plan B and really prepare your financial future and set those goals. So go back to Masterclass 1, and I went through all the different asset classes, all the return on investment that's been achieved, all the results that everyone that implemented the retirement plan B could have taken advantage of or did take advantage of, depending on their next action. So when I think about protection, and we talked about cryptocurrency taxes, and that was led in from the last question as well, I think about, remember the key thing that I said I want everyone to take away is asset allocation. Think about asset allocation which is the key distinction between those, the 1% are wealthy and that pay fortunes to wealth managers to figure out their asset allocations for them. Well, I want you to have the tools to really figure out your own asset allocations. And when we do Masterclass 3, I'll go through my strategies and how I use them as well. Then also thinking about asset protection. This is where it's structuring. Now, there's a real benefit to retirement plan structures is that they allow you, when you get the right structure set up, to defer your taxes, which means it's not about paying no taxes. We'll go through the 5 steps. It's about paying the right tax at the right time using the tools of the wealthiest 1% in the world that we aim to make available to anyone that is able to qualify for some of the different products that we're launching at Retirement Plan B as well. And then you have compounding effects. And I just want to make sure, this might be something that you've heard before, but I want you to appreciate that compounding is such a powerful concept and such an important part of the Retirement Plan B. But the next part of that is the impact of tax deferral. So the whole point of a retirement plan is that it is legally allows you to defer your taxes. Now, tax deferral is a concept that really is transformative. And I'd like to just give you an example of the real benefits of tax deferral. The impact of actually implementing some real sound tax planning. And again, this is not about illegal tax evasion. This is about implementing legal strategies, taking advantage of the things that governments want you to do, which is retirement plans and savings using some of their structures. So let me highlight this example to you to help you appreciate the importance of how tax, when you're thinking long-term as a money manager, and I want you all to be your own Retirement Plan B money managers, asset allocators, is imagine the following example. So imagine if you purchased $1 of Bitcoin and that Bitcoin doubled every single year for 20 years. Now, retirement plan is about longer term thinking, of course. So imagine if Bitcoin doubled every 20 years. Now, I take that figure, and again, historical performance is no indicator of future returns, but Bitcoin on average has grown 113% every year. So it's over doubled every year. So although this is a traditional financial person would find this a very offensive example, a traditional financial planner, because anyone thinking about doubling their money every year, they would consider that's just absolutely abnormal risk. In crypto, that's kind of what we're used to, because on average, it's grown 113% every year. But let's be a bit more conservative and say that it doubles every year. It won't do that. There'll be all sorts of things in between, but it's just a theoretical example to help you understand the power of implementing some kind of efficiency and asset protection structures. In year one, you would have, after a year, $2 a Bitcoin. Simple maths, we'll wait for the slides to catch up for themselves. In year two, we're going to have, where are you? $4 a Bitcoin. In year three, we would have $8 a Bitcoin. And the slides are slower than we need to go. In year four, we would have $16 a Bitcoin. You get the point of where this is going. Where do you think we get to when we get to year 20? Well, by year 5, we've got $32 a Bitcoin because we have managed to successfully defer that tax. By year 20, you would have, if you doubled every year, you'd have $1,048,576 if you're fiat thinking in terms of Bitcoin. So you'd be a millionaire after 20 years if you invested in $1 of Bitcoin and it doubled each and every year, which is what the historical performance has said. But as I said, future is no historical performance is no indicator of future returns. And you need to be prepared for other eventualities, which is why we look at the complete asset allocation structure. But what if you were in a normal jurisdiction And in a normal jurisdiction, the average tax rates on capital gains or whatever it may be in your jurisdiction, if you paid an average of 33% tax at the end of each year, let's have a look at what the impact would be. So rather than you, after 20 years being a millionaire, just by not deferring that tax, and by the way, tax deferral means you pay your tax in the end legally, but you do it almost like pay as you go, then you end up with, instead of being a millionaire, after year 20, you only have $28,000 of Bitcoin. That's how important it is to plan these things out, and why that's a whole industry for the wealthiest 1% to really figure out. And there are tools and things you can use that are available to everybody that are completely legal to achieve tax deferral. So we'll cover more of that, of course, in the third masterclass session. But I hope that just highlights to you that in 20 years, you would either be a millionaire or have $28,000 just based upon not figuring out how to do this in a tax efficient manner using asset protection. And again, I really want to reiterate this. This is not about you doing illegal things and finding out how to mine Bitcoin, secretly coin join it into, move it into Monero and then hide it in a bunker in a private key. This is about you being able to sleep well at night, not worry about any of these things that are happening, because you've planned all this out and you know exactly what your plan is, where you want to go, and how to put together the structures to achieve your goals. So how do you achieve legal tax efficiency? Well, when we walk through the online wealth management program, graduates, the alumni all went through the following steps. Step one was, where are we? Minimizing, the first thing we guided people, sorry, it's a little bit small for me in front of here. The first step we walked through is to minimize taxable events. So stop trading until you've figured out exactly what your plan is and what your consequences are. So that's the very first thing. And we help them understand the different types of things that are likely to be taxable advice without giving, I'm not a tax advisor, as I said. You have to have your own tax advisor on this stuff, but we give you all the tools so that you can then go speak to your tax advisor and at least be speaking the same language. So your first step is to minimize the number of taxable events that you have, which is why we follow that approach in the retirement plan B. The second step is to really start record keeping. And so we go through all the tools and things that make that a lot easier in the crypto industry. Some of the companies that I've invested in that make this really a bit more significantly easier for you, because it's an absolute nightmare. And I remember going through this first exercise. Every single DeFi contract you've done, every futures contract, every trade, every time you've done something, there are tools that make this a lot easier to try and put all that together so that at least you start record keeping from now on, so that you don't have to go through that pain that many people have to do, because now all of the exchanges are being subpoenaed to hand over those datas. Because as I said, predictable, inevitable, guaranteed, when you become a $3 trillion market, governments don't want to ban you. They want to tax you. They want their cut. Of course they want their cut. Why would you ban something where there's so much tax revenue for them to gain? And these theoretical things that people are, that stop them from getting in. And then once you've done that, you've gone through, remember I said, once you know where you're going, you know where you are, then you can fix today's taxes. You can know where you are, get some tax advice, and you can start fixing the situation. Because at the end of the day, if you were involved in crypto for a long time, this shit wasn't clear. And even governments today aren't very clear. But a lot of best practices, as you go to a $3 trillion market, suddenly everything becomes a lot clearer because governments want their cut. So once you fix today's taxes, then it's about deferring tomorrow's taxes so that you can take advantage of legal structures so you can defer. And then rather than being $28,000 worth of Bitcoin after, and remember that didn't even, $28 of Bitcoin after 20 years, rather than being a millionaire, using that one example of starting with $1 and it doubling every year. And then finally, in step 5, once you've been through that complete process, in step 5, it's about you can decide that you either pay as you go, because tax deferral structures allow you to decide when you pay your tax and deferring it along the way. Or you could just decide, sorry if I'm a silhouette right now, it's the white slides, or you could just decide to relocate and get some advice around that. We share people how to do relocation strategies, some of the things you need to consider, and something that I worked with the tax advisor when I decided that time to relocate was the right thing for me. I understand that that's not just about tax. Some people just want to pay their tax, and living where you live is a complete lifestyle decision. Depends your children, your family. At the end of the day, sometimes the right thing is just to pay that tax and live where you want to live. For some people, relocation is a great option, but the important thing is being able to implement legal structures to defer that so that you can take advantage of some of those opportunities. And that is the complete step that we walk through with our online wealth management program alumni, and we go through all the different considerations. And again, I'm not a tax advisor. I just paid a lot of money to tax advisors to help us figure this stuff out. And all the different niches within cryptocurrency that you just can't find the expert accountants. So we found them for you, and we bring them into the retirement plan B and the same advisors that I use to put together this content. Okay, so where have we done so far? We've spent a lot of time on asset allocation by learning the 7 lessons. We were starting to play the ROIs that have been achieved with that asset allocation from those that implemented retirement plan B. You can go back to Masterclass 1 if you want to recap that, because we're running short of time and I'd like to cover some questions. Then we talked about tax deferral and the impact that has when you're putting together a legal strategy. And then the power of compounding is the next thing that I'd like you to understand. So we've had an incredible amount of innovation in how you can earn yield using your cryptocurrency. Now, remember, there is a difference between owning Bitcoin and putting Bitcoin in some of these lending platforms. You need to manage risk. Again, money management, risk management, asset allocation, and this is the name of the game. And in the retirement plan B, we always think about the different types of risks that we need to hedge against so that we can just be unshakable, plug and play, automate, and it takes care of the rest. Compounding. It's been known as the 8th wonder of the world by Albert Einstein. And, many people teach this. And when you go and start speaking with a financial advisor, they start telling you the importance of having a longer term plan so that you can benefit from the power of compounding. Many people in crypto, because they've received exponential returns, they don't get back to the fundamentals 101 of basic finance concepts. Compounding is just the most incredible thing that is a power and that everybody can execute, but very few people do. Why? And especially today's generation are in the age of information where everything is instant results, cryptocurrency where returns have been incredible and they want everything fast, everything very, very fast. And so these longer term concepts are just very unnatural to those that were brought up in the information age and the Gen Z. Go back to the baby boomers, and those that are on the right side of their retirement plans right now planned it in how they benefit from compounding. Compounding is just the concept of earning interest on interest. And there are really easy tools to take advantage of this in crypto. But just to highlight what a compounding looks like, in the early years, you put a bunch of money in, you earn a pittance of interest, and then it just gets a little bit more exciting and a little bit and a little bit and a little bit, and it just grabs you a little bit and a little bit. But if you go and you see all the way through, suddenly it kicks the shit out of the original amount invested as you start contributing. This is the power of dollar cost averaging plus compounding plus implementing tax deferral. And you don't need to do all the crazy shit that people do, trying to find the next Bitcoin killer and gambling all their money. You can just do it through sound principles that everyone can take advantage of. that are just so much more simpler than the complexity that people have in trying to figure out. And because they put so much complexity into it, as we said, you end up that national lottery winner that gambled their way to success, didn't put any sound principles in it, and they don't climb the financial ladder and achieve that genuine financial freedom where the compounded interest covers all your costs, all your dreams, and everything when you just have a longer term plan so that you are unshakable. And this is what, if I could get one thing for everybody that I would want, is taking advantage of real longer term thinking to achieve some of these things. Now, hyper accelerate that with the returns in crypto, and you can condense what most people would plan 20 years into 5 years. When we're talking about retirement plan B, I'm always a conservative guy. I like to be conservative, even though I'm involved in one of the riskiest asset classes in history. I just saw it as low risk. The reason for that is because I saw the writing on the wall for certain asset classes in the financial system, and I saw them as risky when everyone saw this as risky. Combine all these things, and it's incredible what anybody can achieve just with a regular income if they just implement and stick to the plan. And that's what Michelle was trying to say. She just stuck to the plan, put together her plan, and made a big difference within 1 year. Now, you don't even need to make that big difference within 1 year. Most people significantly overestimate what they can achieve in 1 year and completely underestimate what they can achieve in 5 to 10 years. And that drives them to all the short-term behavior that is the enemy of financial freedom because they're trying to just achieve it so fast. And the funny thing is, sometimes when you think long-term, you end up achieving it fast. When you're involved in something that is so disruptive and so misunderstood in the grand scheme of the impact that I believe this all has in the complete reinvention of the financial system that most people still think is a Ponzi scheme, a get-rich-quick scheme, and fiat thinking, and a currency just for drug dealers, or is environmentally friendly, or is all the things that we discussed is going to be banned by governments and therefore they don't get involved. And all the things we discussed in Masterclass 1 of the 7 reasons, and please do go back to that over this weekend if you haven't watched that one already. So with my retirement plan B, once we've got the money management, the asset allocation, the financial plan, I'm taking advantage of 3 compounding effects. And those 3 compounding effects are based upon my philosophy, and that is what is going to be around and what is not going to be around. So you only end up with 3 different things that have proven the test of time, and the use cases on exponential network effects. That is Bitcoin compounding as the world adjusts to our world's best shot at ever achieving digital, hard, sound money with some asset allocation and some risk management sprinkled around. The second compounding effect I'm looking for is the US dollar stable coins. And so I can actually beat inflation with US dollar stable coins. You obviously need to manage the risk. So one of the things we did at Retirement Plan B, I get my lawyers to come along and tell you, here's the risks you need to be aware of legally in the different structures of these different stable coins as bonus content, just for those that want to understand the different risks when they're planning their compounding effects. So, and then the third compounding effect is Ether as a higher risk play on whether decentralized finance becomes something that can reinvent and disrupt every single financial product. And you can have a little bit of your allocation to go play around, but Ether's set to benefit from all this stuff because of the developer community network effect that it's already achieved. And so I benefit from 3 compounding effects. So it's not just growth, it's growth compounding, but also income compounding and understanding that holding some ETH is different to lending some ETH and receiving returns on it. So you need to manage the risk around that as well. And therein lies the 4 protections that we put together. If you take away one thing, thinking about money management, thinking about asset allocation, thinking about asset protection, thinking about tax deferral, thinking about compounding, then you are on your path to just putting together where you are right now, figuring out, putting these through our spreadsheets, where you want to be, and just developing a path to how to get there. And that is exactly what I want for everybody. And the reason why we're doing this live masterclass is to just empower upon you that there is a lot that you can do just based upon this free information. And we'd love to have you if it's right for you and you're one of those people that would like to join us on the online wealth management program when we open for enrollment after video 4. So that's all the content. I hope you enjoyed that. We're going to now take some questions, and then I'm going to cut before about, Dave will let me know when we get to about 10 minutes to 8, and we'll move over to the secret, the bonus segment for the live viewers, which is a sneak peek inside the Retirement Plan B online wealth management program with some of the guest experts that make up. And today we're going to be doing Pamela Morgan, who is my go-to expert when it comes for crypto asset inheritance planning, and just a deep understanding of as both a computer scientist as well as a legal professional as well. So that's going to be the live viewer bonus content. We'll put together that, and we'll be wrapping this up at about 8 o'clock. And this is a segment taken from inside the Retirement Plan B online wealth management program for those looking to put together their crypto inheritance plans. After all, so many, Bitcoin is a bit lethal. As people pass away, if they don't plan their inheritance, it benefits everyone else in Bitcoin because those private keys get lost. But it's really bad for you and your family, your loved ones, and your estate. So please, please, please consider what goes beyond you and what happens to your crypto assets after you, and in case anything happens. Right. Okay. So Azad, hopefully we can do a screen share right now. So how are we doing for time? I haven't got my watch. I forgot to put my watch on. I was so excited about doing this.
Yeah, we've got 20 minutes. So.
Okay, 20 minutes. So we're going to do 10 minutes of Q&A and then 10 minutes for the sneak peek part of this. So I can do about 12 minutes. I think it's about 8 minutes, the sneak peek part. And then we're going to wrap this up and over to enjoy over the weekend, rewatch, do whatever you need to do. Please do share if you like it, as we said. Share this with your friends and family. I want this information out to as many people as possible. If you're watching this on YouTube, like it. Show us some love. Put in the comments as well. We're going to be returning back to all these things so that we can, pick out the questions as we do more sessions. So let's do 12 minutes of questions. Azad, pick out a few good ones. I've got you on the earpiece.
Any credible crypto tax accountants in the UK?
Oh boy, this is a hard one. Some of my the experts that I work with, they had to put together courses just to find people and teach them. But this is such a growth industry right now. It's a really booming sector. So if any of you are tax advisors or you're accountants, boy, is this an exciting place to be. There is, a myriad of millions and millions of people that have onboarded onto crypto and need this help as well. So it's a growing and growing sector. In the wealth management program, I can't recommend individual people for you, but just have it be known that it is a growing sector. And some of the experts from our wealth management program had to put together courses just for accountants because the industry is growing rapidly compared to the professionals that are trying to catch up. So sorry, I can't individually recommend you one, but if I mention my tax advisor, and I do have one, then when we mentioned him in the wealth management program, he just wasn't being able to do that. If I did this on the live broadcast, he'd be inundated, but there are people out there. So here's what I would say, the tip on that. What we do is we give you a language that you can take to any tax advisor and any accountant that equalizes their traditional understanding. And then we unpack all of the different cryptocurrency transactions, and then we relate it to a traditional tax transaction. And then you can just go take that to your traditional accountant, and they'll probably charge you for learning all the stuff and then become an expert cryptocurrency tax advisor. Next question.
Okay, a question from Matteo. Is joining in your program legally like operating a self-directed retirement account, pre-tax money, with whatever it means in the different jurisdictions?
So we have two different products here. The online wealth management program is educational. It's for you to be able to take the tools and implement all of this stuff, asset allocation, asset protection, put together your own plan, whether you use us to do it or not. And we did launch a new product that's in beta at the moment. And we've got 10 of the wealth management program graduates that have been through that, and a big queue from the other 500 that want to join that. And we are releasing our portfolio builder, which is an actual asset protection structure that automates the whole retirement plan B. And at the moment, that's only available to those for regulatory reasons that have $1 million of assets or more. But we're also applying for a license to be able to scale that next year and make that accessible beyond just the high net worth investors. But that's all dependent upon our regulators confirming that that's something to do. So just to be clear, the online wealth management program is you having all the tools you need to implement and put together your plans. And the portfolio builder is a product that actually does it for you under a structure, the same structure that I use. What I did is I spent hundreds of thousands, and we got KPMG and all sorts of people to sign off on our structure, spent all the money for you. And then I put together the same structure, and we're trying to make that available exclusively to those on the online wealth management program at the moment. And in the future, we'd look to make that available to a wider audience. But at the moment, we've got so much demand, it's only available to those that complete the online wealth management program, because we need people to be educated on this stuff so that they know what they're doing. They've got a longer term plan. They don't abuse the tools. But as I said, at the moment, the online wealth management program, to be clear, is available for anybody that wants to register after we open up after Masterclass 4, but the portfolio builder product is only available to high net worth investors due to regulatory restrictions while we apply for additional licenses to open it up wider. Next question.
Will we be able to make payments or investment to you in our local currency should we be successful in joining the program?
So the program, you can pay by card or you can pay by crypto, and that's what you can pay by stablecoin, Bitcoin, Ether, or you can pay by cards, just like we did last year. And so if you have a card and you're able to make, it's priced in dollars. So most people in their cards just do an FX at the card payment.
Can you have a trust that protects you? There was an irreversible spendthrift trust someone spoke to me about. What kind of trust could secure my assets?
So this is where I would defer to the experts in Retirement Plan B. I'm not a lawyer, but trust structures is one of the subjects that is covered by Pamela Morgan and Adam Vaziri, some of the lawyers that are part of the online wealth management program. And trust structures is normally an asset protection structure rather than just for the tax. If you set up a trust structure just for the tax reasons, then governments have been implementing all sorts of rules to try and close some of those loopholes. But yeah, trust is certainly something that the wealthy use, and it's a topic that is covered. Is beyond me at the moment, because that's very much a lawyer question. But we will be discussing structuring in the Masterclass 3.
Simon, this is great. How can I move to the Retirement Plan B on your bank?
So I failed at creating a bank, so I don't have a bank. But we do. BnkToTheFuture.com is a securities platform that allows people to invest in the future of finance and Bitcoin and crypto companies. So I don't have a bank, but at BnkToTheFuture, I am investors in banks. So we've got crypto-friendly banks like FV Bank and Kraken, who's got banking, and Coinbase and some of our other portfolio companies. So what we decided to do is put together a way to be able to invest in the whole industry rather than me having to create a bank, which, as I said, I completely failed at. But we're investing in companies that are building out crypto-friendly banks, and really exciting growth area to look at. So you can't use my bank because I don't have one. Azad, let me know when it's about 8 minutes to 8.
Okay, If you are comfortable in status in life with income which is stable, no debt, and an investable portfolio, what is a good percent to invest in crypto?
Again, this is individual financial advice. So in order to answer that question, I'd need you to go through your cash flow statement, go through your personal balance sheet, use the tools that we put together in order to plug in all of the crypto financial models on the spreadsheets. And then you need to combine that with understanding your personal situation. So there's no such thing as an optimum amount to put into crypto. It all depends on when you need to retire, what your level of indebtedness is right now, what your financial dreams are. So when we talk about, we go through a whole financial ladder process where people start saying, by this date, I would like to purchase this thing. And they put together different bucket allocations, and they put together different security and different things. So I can't answer a generic question like that, because that's what a financial advisor does. They sit through and they go through, well, you want to put your children through college, or you've got this mortgage and this amount is in debt, or you have this many assets, or you don't. So that's the only way to answer those questions. There's no generic answer for everybody. You must have this amount in crypto.
Okay, so Simon, I'd be interested to know if you hold any cryptocurrencies other than Bitcoin and Ethereum, and what your relative asset allocation is to them.
Yes, I do. And when we go through video 3, I'll go through my complete asset allocation in my retirement plan. And then I have an allocation that's just for fun. And as I said, I like a little bit of the tinkering with DeFi projects. I like to play around with all the innovation. I'm a guy that, is built my whole career on financial innovation and being involved in that. So I love to play around with those things. I got a lot of stuff that has popped up over the years, but it's not my financial plan. I have, an allocation that's just for tinkering around. I know when I'm gambling and when I'm not gambling, and I don't bet my future on that. So I know the question that you want. You want me to tell you what exactly ones I have, so that then you can go and go do that. Well, I'll do that for my retirement plan B. But as I said in the beginning, this is not me telling you, here's a tip. I want to discourage that type of behavior. Bowing down to people that you consider that are more financially savvy or more involved and following them along. That's not the path. The path is self-empowerment, unshakability, preparing for all eventualities, and we'll cover more on that in the Masterclass session 3. These are really good questions. I really appreciate these questions. I think, Azad, we're going to have to definitely spend more time, maybe do some additional sessions, once we're open, to cover more of these questions, because when those 500 spots go, I want to make sure that I could cover more questions for more people as well. But yeah, these are really great questions we've got here.
Yeah, we have a lot of questions around taxes and what do you call it? Mortgages, UK-based mortgages and crypto loans. So I think let's make this the final question, because we're coming to 8 minutes to 8. Question from Chris: are you liable for capital gains tax if you swap between different cryptos, example Ethereum to Solana, or even between ETH and any stable coin?
Okay, great question. But it's also a really horrible one to end on, but we will end there because I'd like to answer that question anyway. So firstly, I have to disclaim it. I am not a qualified tax advisor. And it also depends on your jurisdiction. But most jurisdictions consider swapping one cryptocurrency to another cryptocurrency a taxable event. And so the way that it would normally be looked at is, let's say you got Bitcoin and you go into ETH. Then what you would need to record is you would need to record the amount of fiat currency that you purchased that Bitcoin for. And then you would need to have that in your records. And then let's say you converted some Bitcoin to ETH. The way that most tax authorities look at that is you have fictitious fiat in the middle. So imagine you're American and it's the IRS. Sorry, I focus so much energy on America. We are in a global world. China is the next superpower of the world, sorry to say. But America is such an important, because we are still in a US dollar debt-based standard. But anyway, let's say the IRS is looking at what they would do is they would say, when you sold your Bitcoin, you sold it for fictitious dollars, and those fictitious dollars then bought ETH. So you would need to record the Bitcoin to dollar exchange rate and the dollar to ETH exchange at the time of making that transaction. And most jurisdictions would consider that a taxable event. And then whether it's taxable or not depends on your structuring. So there's a real dilemma in the crypto industry. Andreas Antonopoulos, one of the experts that gave bonus content on security for the wealth management program, he talked about not your keys, not your coins. At the same time, most wealthy people don't want to own things. Crypto gave you the ability to own it. So it creates a bit of a dilemma, and that's one of the things we go through, getting the risk management approach, because the efficiencies that come from not owning things, whereas Bitcoin gave you the ability to own. So it's a real dilemma, and I think that's a great place to segue into Masterclass 3, where we're going to be really focusing on so this class was about how do we deal with cryptocurrency tax and the 7 lessons and mistakes, asset allocation, asset protections. And then Masterclass 3, we'll be doing the whole session on building a retirement plan, which relates to structuring, and of course, reviewing video 3, which is the whole strategy that we use at Retirement Plan B and the exact makeup of my Retirement Plan B that I publicly invested in for the online wealth management program graduates and alumni. And now we are over to the live viewer bonus session. So if you're watching the recording right now, then we're going to be cutting off after this. We'll give you a little sneak peek. But for those of you as a reward, I can't believe how many people stayed for me talking for 3 hours. Last time we did an incredible amount of time. We're going to now go over to the final video where we introduce you to Pamela Morgan, the author of Crypto Asset Inheritance Planning, and one of the experts that gave bonus content for the Retirement Plan B online wealth management program, so that you can segue into part 3 and start thinking about some of the complexities and nuances around crypto asset inheritance planning. So I hope you enjoyed that content. I'm going to go and read. If you are on YouTube or any of those social networks, or if you're on Twitter, hook me up at Simon Dixon Twit. Tell me what you think. Tell me what you'd like to see covered in the future masterclasses. Tell me any feedback that you'd like to give us, and also leave a comment on YouTube. And if you appreciated it, I would really appreciate you if you gave us a like, gave us a share, and shared this with your friends and loved ones that you think would benefit from really immersing and spending time in thinking about their financial future in one of the most uncertain financial times in history. So always remember, you are alive at one of the most interesting and exciting times in financial history. Many people are going to get hurt. Others are going to do incredibly well. I want you to be on the right side of that change. Peace. And Pamela Morgan will now go into the live viewer bonus content. Thank you, Dave. Thank you, Azad, for the questions. And more importantly, thanks to everybody for participating, playing full out. And because of that, I'll give you a lot more content while we cover this for the next week or so. And that's it. Over and out.